Hi, I'm Arkansas Auditor State Dennis Milligan, and this is Bob. Bob has unclaimed cash in the Great Arkansas Treasure Hunt.
Wait, really?
Bob's been sent a check without doing anything.
We have cash?
The state legislature passed a law that allows me to send him a check when his data matches our unclaimed property.
Hey, we have cash!
Keep your eye open for a letter from me. It might be your lucky day, just like Bob. Kind of cheesy, but we needed something to kind of attract attention. The thing that's probably most disappointing to me as your auditors is everybody wants to know who Bob is. And so I've got to get some new material, Kurt. Well, let me open up by saying welcome to everyone. Thank you for being here today. I'm from the government and I'm here to help. It's picking up, Kurt. Yeah, that's of course many of you, or not many of, but we have a number of people listening online or following us online too. But I'm Auditor State Dennis Milligan. I will say this, I know my team has put a lot of work into arranging this seminar for you today, so I'll try to be very brief. Even though I hold the title of auditor, my main responsibility is not auditing. I'm in charge of payroll for the state's executive branch, legislative, and judicial branches of government, over 700 people's paychecks. So trust me when I say I don't want any state legislator or the governor calling me because their paychecks didn't go through. Many of you in this room and online don't know my background. I come from the private sector. I owned and operated a small business for over 35 years. Nothing scarier in my book than being responsible for a Friday payroll. So when you're in business for yourself, you get that, and results do matter. Without setting bold goals for myself and for my team, I wouldn't have been able to expand our business, I believe, into 17 different states. I bring that business mindset to work with me at the state capitol each and every day, and I have a great staff, and I'm very proud of the goals that have been set for them, but they buy into what we're doing, and I certainly want to give them accolades and credit for our successes. Really, one of my goals and what I get out of being your auditor of state is I simply want to be the auditor that's known as giving the most money back to Arkansans than it's ever been done. That's my probably my business mindset is, again, we have to produce results. So it brings me to the reason you all are here today in person and online. A major part of my job is overseeing Arkansas's Unclaimed Property Program, the Great Arkansas Treasure Hunt as it's better known. I'm required by law to make people aware of this program and help return unclaimed property back to Arkansas. Just to note, we have approximately $400 million that belongs to Arkansans. The flip side of this program is getting those financial assets remitted to my office, and is why we're holding the seminar today. In the following sessions, you'll hear more about what types of financial items constitute unclaimed property, the timelines for property to be considered abandoned, and the ways in which you can report unclaimed property to my office. One of the difficulties we face when trying to get these monies back into the hands of the rightful owners is a lack of identifying information. Over the years, this office, and this amazes me sometimes, over the years we've received financial assets, cashier's checks being a prime example, without any identifying information. So we literally have properties worth hundreds of thousands of dollars that have been remitted to my office, and we don't know who it goes to. This is a challenge, obviously, for our team, even though I'm required to, by law, to return unclaimed property to its rightful owners. I have no way of doing that in these cases. And moreover, Arkansas law on unclaimed properties, it stays in perpetuity. See, Kurt, I said a big word there. Yeah. Which means that even though we have no way of reuniting these funds with the rightful owners, we're required by law to hold on to them. So here's my request for each of you. Do your due diligence when submitting funds to my office. It's imperative that you include all the information you can on a person's financial property. Please be mindful that there are people on the other side of the computer screen that are also doing their due diligence in trying to reconcile these monies with their rightful owners. At the end of the day, it's not our money to keep. So we need you all to make sure that you're submitting complete and thorough information to use my team so my team can use and do their jobs effectively. I set bold goals for my unclaimed property team, and I expect them to reach those goals. Your diligence in remitting properties to us is a critical step to making this happen. I appreciate all of y'all being here, your time and attention. I'm going to turn it over to Josh now so that we can get started. And again, thank you so much for your attention and being here. It means an awful lot to me. Thank you, ladies and gentlemen. Josh?
Thank you, Auditor Milligan. I don't know about y'all, but I am so thankful to have a boss that cares about the office enough and cares about the mission behind unclaimed property and understands the mission of getting the money back to the rightful people. Okay, Josh, 20's all I can do. All right. if I just want to give him a round of applause. Thank you. Well, without ado, I always like to start out a seminar by polling the room. And I know I can't poll everybody online. I'm sorry. I'd like to poll you too, but we've got about 35 people in the room, so I think that's a good gauge. Who all has heard of unclaimed property? Wow, that's 100%. I remember the first time that I presented on unclaimed property, there was only about a third of the room that raised their hand. They're like, I don't know what you're talking about. But by now, most people have heard of the Great Arkansas Treasure Hunt or different programs around the nation. Everybody has their own way of displaying unclaimed property or getting it out or telling people about how they can get their money back. Everybody wants their money back. So, in my opinion, unclaimed property is the greatest consumer protection set of laws in the United States or in the world. And that drives the mission of unclaimed property because we want to protect the owners. But we want to do it in a way that allows the holders to be able to help us doing it. So these presentations are meant to move that mission forward, to help you help us. Is that a good way of putting it? But so now we're going to start out with a Holder 101 presentation. What is unclaimed property? And we're going to kick it off with Robert Scott. He is a senior manager for EECS. He is an unclaimed property auditor, and he works for a firm that provides its services to dozens of states around the country. In his capacity as a senior manager, Mr. Scott has experience supervising and conducting both unclaimed property examinations and compliance programs for EECS. He has worked in the unclaimed property space for over 30 years, engaging with state administrators, holders, and holder advocates in connection with unclaimed property reporting, audit, and voluntary disclosure initiatives. Prior to joining EECS, Mr. Scott was my boss and taught me most of what I know. He was the unclaimed property manager for a number of years and worked in the Auditor Estates office for over 20 years. So if you would, please welcome Rob Scott.
Thank you. So I know Josh polled the room and everybody had heard of unclaimed property. So this start is just an unclaimed property 101. So most of it you'll be familiar with, but hopefully there'll be something new to you. Let's get this. Hey, Curtis, this doesn't seem to be working. There it goes. Okay, so what is unclaimed property? It is any financial asset, most of the time intangible, with the exception of, for instance, safe deposit box items, and held for a person or an entity. An entity or individual cannot be found if there is no documented transaction or contact between the owner and the holder for a certain amount of time. Arkansas's unclaimed property statute defines the period of time for each property type. The majority for Arkansas is a 3-year dormancy, but there is also 1 and 5 year and 1 15-year. So what can be unclaimed property? What are these properties? They could be account balances and checking, savings accounts, could be brokerage accounts, could be unpaid wages or commissions, can be stocks, bonds, could be refunds or utility deposits, could be any insurance proceeds, cashier's checks, money orders, safe deposit contents, and oil and gas royalties, and pretty much any intangible property that may be owned to a third party. Okay, so some basic terminology is when it's referred to as a holder, that is the business that is in possession of the unclaimed property. That's what we refer to as a holder. So that would be the companies that file the reports with the state. An owner would be the person who has a legal interest in the property that the holder is holding, or a legal representative. When we say due diligence, that's a written notice to the owners of the last known address informing them that the company, the holder, is holding property that they think may be owed to them. And this for Arkansas would be any amount $50 and up. Information, a record is information that the holder is holding that relates to that property that is owed to the individual. And it can include any identifier, and not to be limited to, but the name of the person owed it, the date that it was last, or issue date or date of last activity, or it also includes the value, maybe social security number, the owner's last known address. Basically, the more information provided in that record, the more likely the state is to reconcile that with the owner. When we refer to NAPA or NAPA format, NAPA is the National Association of Unclaimed Property Administrators. And this group basically sets the standard for reporting unclaimed property. And when we refer to the NAPA format, that is the national accepted format to file reports. All right, this is, so getting to know NAPA. Like I said, it's the National Association of Unclaimed Property Administrators. And the current version of that standard format can be found at www.unclaimed.org, which is the National Association site. And Arkansas does require all holders to file their reports in a NAPA format electronically. Now, there are several software products on the market that can help you. There's a few listed here: UP Exchange, FSI, Tracker, or HRS Pro does have a free version. Or you can enter your information if you've only got a handful on the manual entry report on the auditor's website. Okay, so what does the law require that you do with unclaimed property as a holder? First, you must identify that unclaimed property, which that would be any amounts that are, for instance, outstanding checks that have not cleared the bank, any bank accounts that have been sitting there for an extended period of time. And then once you identify what type of property it is, then you determine the dormancy period for that property for the state. So, for instance, if it is a insurance proceeds check, it would be 3-year dormancy. So once you've determined dormancy, or wages would be 1 year. Once you determine that dormancy period for each item and you have your list, then you perform due diligence for all of those items that are $50 and over by sending a letter out to the owner. Then you collect the information back from these letters, and if there are any that have said, hey, I need this money, you'll go ahead and pay them before reporting to the state. And of the items that are left that have not been claimed, then you would prepare the report listing all of the properties and then file and submit with the state. So how do you determine if your business has unclaimed property? Well, you can analyze your general ledgers to determine, when we say that, we mean it could be that you have an unclaimed property liability account where you've moved aged items into. It could be your checking account that you've got a list of outstanding checks that are aged, old enough to report. It could be in the case of a bank, it could be your customer accounts, something like that. So you would review those relevant records depending on what type of business you have. And you can always check the Arkansas Auditor of State's website for any changes and updates to the unclaimed property laws. So a dormancy period, so for instance, if it's a 3-year property, and I think that's a little back, but this coming year is going to be November 1st, 2025, would be the report due date. So you would be looking for 3-year property, you would be looking for anything dated from July 1st of 2021 to June 30th of 2022. So going back to due diligence, by law, owners must be provided at least 90 days to respond to the due diligence letters. So you must have those out well in advance of the November 1st deadline. And as we said, they must be performed at the value is $50 or greater. And there are sample due diligence letters that are available on the state's website. We've got a couple of examples of due diligence letters here. The most common thing is they all will have to have, one, the owner's name and last known address that you're sending it to. It'll have to have a description of the property that is due them. And it'll have to have choices for the owner to choose, and also a signature for them to sign to send back. And this is another example for an owner to be able to fill in the reason. So, gathering property and owner data. For the owners that you're unable to locate and don't respond to due diligence, you'll collect all the information you have, such as the last known mailing address, social security numbers, even birth dates, and if there are more than one owner of the property, we would need the relationship codes of those owners, such as and, or, joint tenants, etc. The transaction date of that property, the property type, and if it's oil and gas, a legal description of where the royalty is being paid from. So we're going to compile the required information for the report. The report should include the property type, the owner name, and last known address, social security number, and all other information you have. The name and information of any known beneficiary, if there are beneficiaries listed for the property. And a description of the property, which would include either a check number or account number. And then the start date, which would be the date the property is presumed abandoned. So that would either be in a bank account, it would be the last date of contact. For like a check, it would be the issue date. And or if you've talked to, or if they've responded in writing, then you must document that as well to update the date. So to create the report, which most of you probably have done, you'll register and log in, have an account there. You'll enter your information, the company information. Then you'll enter the property information in a two-step process. This is for a manual report. You'll enter your owner information and the property details. For an electronic filed report, you will upload the electronic file. Then you will review and agree with the report summary and submit the report. I think we got a copy of the Auditor of State's page here where you would go to file a report. You would go to the property tab up top and go to submit a report. And as we referred to, Arkansas does require all holder reports to be submitted in a NAPA format. And all payments must be received prior to that November 1st reporting deadline. And we've got the website here for you to go to pay the report that's due. And so in record retention, it's very important that you save any records and support you have that relate to that unclaimed property report. So if it's any contact information, if it's multiple addresses that you had, prior addresses, it's very important that you keep and retain all of that information. And it used to be 10 years. Is that still it? So 10 years from the date of the report. Some additional notes are, if you're using one payment for a report, and which is normal, then if you have multiple reports, then all those reports must be combined and filed in one filing. And any payment or transfer remitted to the state prior to the submission of the report, it could be returned back to you. The report should be filed first. And any payment not using the approved method will have to have a written approval from the Auditor of State's office prior to being paid. And just paying the funds does not relieve the holder from the obligation to file the report which lists all the property. Now, if you need a W-9, they can be requested by sending an email to holders@auditor.ar.gov. Are there any questions on the basic terminology? Thank you.
All right, thanks, Rob. That was a great introduction to unclaimed property. We get to now see use his terminology, and we're going to use that throughout the day. So if you hear the word holder, you know what a holder is. If you hear the word due diligence, you know what it is now. So we'll likely use those words quickly and just go through it. So in this presentation, we're going to go through a Holder 201. We're going to dive into the presumptions of unclaimed property. Each thing that each industry might be holding. Of course, it's very heavy on financial institutions because the statute is. Because I don't know if you're aware, a bank holds more types of unclaimed property than any other form of any other holder. that they'll hold all of the account balances, your IRAs, your safekeeping, checks, cashier's checks, money orders, a whole long line of them. Whereas we might go quickly through like checks or money, and that might be applicable to some of the bank type property, but it's likely going to be the heavy predominating type of presumption of abandonment for most holders is an outstanding check that you're holding on your books and records. Maybe it's a vendor check, maybe it's a payroll check, but I'm going to go through well, I'm not going to go through all of the presumptions of abandonment, but I'm going to hit on most of them. Can you click? There you go. So, and go ahead to the next one too. All right, so we're going to hit on account balances. So this is your checking account, savings account, Christmas club account, different types of account balances. Most of which would be held at a bank or a financial institution. We also consider, say, a pay card to be an account balance. Let's see. Property is presumed abandoned if it is unclaimed by the parent owner during the time stated below, which is 3 years after the earlier of maturity or the date of the last indication by the owner of interest in the property. So the interest in the property is really the most important thing that I pull out of that. If an owner still has interest in the property, then it wouldn't be abandoned. So if they've called you and you've made a record in your notes, in the notes within your system that they called to make a change to the account, they changed a mailing address, or they requested a transfer of funds, or they've issued a check, or they've used their debit card at an institution. Those are interests in the account. Now it goes on to say, but a deposit that is automatically renewable is not matured for the purposes of this section upon its initial date of maturity unless the most recent correspondence from the financial organization to the owner has been returned unclaimed or undeliverable by the post office. Now those are CDs. Those are your certificates of deposit. Now, a general certificate of deposit that, say, you buy it on one date, it matures in 3 years, and it's not automatically renewable, then upon maturity, that starts your trigger for abandonment. Whereas most of the banks in the room probably know that most of the CDs that are issued in today's day and time are automatically renewable. So when we first started looking into auto-renew CDs back about 8 years ago, we found out, we were talking to some banks, and there were people that were 150 years old, and there was no reporting because it just rolled over. It kept rolling over. So what we do now is we ask, because it says the most recent correspondence from the financial organization, we ask that holders send a renewal notice at or about the time that a CD is due to auto-renew, prior to that auto-renew cycle. If you get return mail, then that stops the renew. We don't want you to allow it to keep auto-renewing after you've returned mail, because that would show that you don't have, or the owner is not showing interest in that property. So then that return mail would start your trigger for reporting unclaimed property. And you heard Rob talk about dormancy period. So that's the starting date for your dormancy period. So on a CD, it would be 3 years. So start the 3-year clock right there. Let's click over to the next one. Can you go back one? Okay, indication of owner's interest. Yeah, I can see why you skipped over that because I already hit on that. I talked through a lot of the different indications of owner interest. But the key point that I want to point out here is in section 2 right there where it says owner-directed activity in the account in which the property is held. So if you're looking at is this an owner-directed activity on the account, there are some things that are owner-directed, some things aren't. If you set up, say, dividend payments to come into the account and they come in regularly every 3 months or what have you, that's not owner-directed because it was started maybe 20 years ago, and we don't want that account balance we don't want somebody to end up being 150 years old and that account balance still sitting there. So we need it to be owner-directed. An owner has their fingers on it, and they use their debit card, they make a change of address, you've got contact with that owner, they're making this isn't listed in the statute, but we do recognize that a login to an owner's account to their online accounting or your online secure web page would be interest in the property. All right, we can click over to IRAs, and I'm gonna go through IRAs a little bit, and I think we're gonna get into it a little bit more later on in the question and answer on the 4th session, because there was a very well scripted question that was asked about IRAs. So we have somebody that's going to talk about that. But an IRA, an individual retirement account. In some cases, an IRA can be reportable to the office. Now I'm going to read it verbatim here, and then I'm going to explain it a little bit. Property in an individual retirement account, defined benefit plan, or other account or plan that is qualified for tax deferral under the income tax laws of the United States, and emphasis on under the income tax laws of the United States. So IRS kind of scripts some of the directions. It could be presumed abandoned 3 years after the earliest of the date of the distribution or attempted distribution of the property. The date of the required distribution is stated in the plan or trust agreement governing the plan, or the date, if determinable by the holder, specified in the income tax laws of the United States, by which distribution of the property must begin in order to avoid tax penalty. Now, and you can go to the next page. On here, there's a link to IRS's webpage about required minimum distributions. Here within the last little bit over a year ago, they updated what the mandatory age would be for requiring minimum distributions. They went from 70.5 to 72, but that's not retroactive, so it's whenever a plan starts as of that date, then that would be 72 years old, but all the old ones that we're still holding that haven't been reported are still on 70.5. So there can be some confusion there, but I'll direct that to the IRS, and you can ask them to be more clear, and we would be very thankful for that. But I'll go back. What's not confusing is the distributions. If a plan participant requested a distribution, and that distribution was attempted or was made, that's your trigger for abandonment. So it would be 3 years after that date, it could be reported as unclaimed property. Now the plan assets, that's where it comes in. You have to look at your individual contract with the plan participant, or you look at the IRS's instructions on when the plan assets could be reportable. And securities. Anybody here report stocks, mutual funds? I know there's a lot of people online that are probably trying to raise their hand. Because there are people online that this applies to, I'm not going to skip over it. But this would be your stocks, mutual funds, stock or other equity interest in a business association or financial organization, including a security entitlement under the UCC 48101 et sec, could be presumed abandoned 7 years after the earlier of the date of the most recent dividend, stock split, or other distribution unclaimed by the apparent owner, or the date of the second mailing of a statement of account or other notification or communication that was returned as undeliverable, RPO, or the date at which the security is presumed lost or unresponsive, according to federal law. So it's A, B, or C, not a combination. You can use the lost or unresponsive direction because you're already required to use that by federal law. We say, why redo everything? If it's considered lost or unresponsive, go ahead and use that trigger as the starting for unclaimed, as the starting to determine abandonment. Or you can go back to the old standard if C doesn't work. If you can't presume it lost or unresponsive, you can go back to A and B, and that's going to cover everything else. For your stocks, the date of the most recent dividend, stock split, or other distribution, as long as it's not automatically applied to the account, and you're issuing dividends, a cash dividend, then A would work for you. You go by the date of the most recent dividend that's not paid out. If say you're reinvesting the dividends into the stock or the mutual fund, and it's just accruing more stock or mutual funds, then you can't go by the date of the last payment of the dividend, so you have to look at the mailing of a statement of account. And so a mailing of a statement of account or delivery of that account statement is important in those cases. Lost or a lost security holder and an unresponsive security holder are provided on these. I'm not going to go through each of these in depth because it's not within our law, it's within the federal law, 17 CFR 24017 AD 17. So I'll just leave the lost security holder up for a second. Will you click over to an unresponsive payee now? So a security holder shall be considered an unresponsive payee if a check is sent to the security holder by the paying agent and the check is not negotiated before the earlier of the paying agents sending the next regularly scheduled check or the elapsing of 6 months or 180 days after the sending of the not yet negotiated check. Security holders shall no longer be considered an unresponsive payee when the security holder negotiates the check or checks that caused the security holder to be considered that unresponsive payee. So safekeeping, this is what everybody wants to know. You want to know about that lost Krugerrand or the lost gold that was left in a safe deposit box. Now, safekeeping, over the last 4 years, we've had some machinations on what we expect as far as reporting on them. You'll probably find now that we don't accept a whole lot, which would be true. But what 1828-203 says is, and it sets up the date of abandonment when it could be considered abandoned, would be 5 years after the expiration of the lease or rental period on the box or other depository. So where you could read other depository into, hey, it could be lost things that somebody left at a hospital, or something that somebody left at a check stand at a grocery store. That's not the case because they're not paying for a lease or rental period. So really the only thing that could be scoped in as a safekeeping item that could be reportable to our office is something that somebody is paying a lease on. So a safe deposit box content is the primary type of safekeeping that we take in. It is the only tangible property, other than if you consider a stock certificate a tangible item, that we receive as reportable as unclaimed property. Now, as far as the reporting of safekeeping, we don't accept certain items, such as we don't want cremains, we don't want guns or ammunition, we don't want drugs or paraphernalia. Most of those items should be reported to your law enforcement or disposed of in whatever however you have set to do it. One other type of item that we don't accept is anything that's considered to be worthless. Anything that doesn't have the value of, doesn't have more value than, or we wouldn't be able to receive any commercial value back from auctioning it. Say your life insurance documents, deeds, paper documents, things like that. They're considered. Somebody could go to a department and get a copy of that. They could pay a fee somewhere at another office and get that replicated. Savings bonds we do accept, and your bearer bonds, if any of those are still out there, we would accept those because those do have value if you turn it in and redeem it. Another type of item that we will accept in certain cases is a stock certificate if it's a private share that's not traded on the open market. Before I jump into the next two types, are there any questions on those so far? I know I went through really quickly. Yes, ma'am.
So does that mean that we can send tangible items to you all? At one point we had to auction before we reported.
Okay, the question was, does that mean that we can send tangible items to us? The expectation was that, or we understood the expectation to be that it needed to be auctioned off before being sent in. And yes, I did leave that out. Thank you for pointing that out. The expectation is that you will attempt to auction off contents with the banking statute sets up a mechanism, a time frame in which you can go through. After 2 years of non-payment, then you can open up the box, and then you have 3 years from that period that you can attempt to auction off contents. We would like for you to auction off contents if you can, and make an attempt to auction off contents. If there are some items that have been attempted to be auctioned, but they do have commercial value, you weren't able to auction it, those items can be reported to us. Does that answer your question? Good.
Reported and sent, or just like when you're saying reported, do you mean go ahead and send those in if they can't?
Reported and sent. So the report is due November 1, and then you don't send the contents until March 1 or March 30th. It's 90 days after. Any other questions before I jump into checks? No? Okay. All right. Checks or money. This is the majority of items other than the next item that get reported to our office. So I pulled out all of the different types of checks that are listed here. Now, you've got traveler's checks, money orders, money or credits owed to a customer as a result of a retail business transaction, property distributable by a business association or financial organization in the course of dissolution. So if your company goes bankrupt or you're closing shop, then you've got 1 year to report items. Property received by a court within a class action or a court action, wages, payroll, deposit or refund from a utility. Those are all different types of checks or similar to checks. The main thing that I want to point out on this page are the underlined words, and that would determine what the trigger would be for that type of check to be reported to us. In most cases, it's the date of issuance. The date you issue the check starts the dormancy period. So for traveler's checks, money orders, the date of issuance would be the start the dormancy period. For money or credits owed to a customer as a result of a business transaction, and this is your credit balances as well, because the date of issuance isn't going to really be or give a good picture for how to pay out a credit balance, because you may have never issued a check. It may just be a credit that's held over for multiple years on your records. So in those cases, it's when the obligation accrued. So whatever your lawyer says was the date the obligation accrued would be the date that the credit balance or those the money that's held there in that form or fashion would be presumed abandoned and could be the dormancy period would start. So unofficially, I generally say for a credit balance, the day that you create the credit balance on your system would start the dormancy clock. Property distributable by a business association for dissolution, that would be 1 year after the property becomes distributable, because we know that, hey, you might be held up in bankruptcy, so it might not be distributable until the court says it's distributable. Or you might be closing shop and you're getting ahead of the game. So when you see that it's an obligation that should be paid to somebody and you're closing up your records within 1 year after the date that it was distributable, it could be considered abandoned and reported as unclaimed property based on that dormancy period. So you get a shortened 1 year dormancy period for that. Whereas it might be 7, 15, 3 years, 5 years, 7 years. If you're closing up shop, it closes the gap down to 1 year, because we know you're not going to want to close up shop and then still have an obligation 15 years down the road to still keep up with these books and records and report unclaimed property. All right, and we've got wages, payroll. That's 1 year after the it becomes payable, and we've got deposits or refunds on a utility. It's 1 year after it becomes payable as well. So, if it's payable, if somebody earned their due wages and it becomes payable, that's when you start the abandonment period. It's not necessarily even when you issue the check, because there might be a glitch in your system and checks don't go out for 2 weeks. So it would be when it's payable, when it's earned and payable. Okay, and the all other clause, and this is, in my opinion, the most important part of it. The most important clause within the abandonment period, or the Section 202 presumptions of abandonment. Because when we adopted the 1995 Act in 2003, the writers of the Act couldn't presume to know what types of properties would come up in years to come. But they did know that there was a likelihood that there was going to be something else, virtual currency, for one. Different items that wouldn't fall under one of these different triggers for abandonment, or different presumptions. So that's why they created the all other property clause. So anything that doesn't fit within one of those other presumptions is presumed abandoned 3 years after the owner's right to demand the property, or after the obligation to pay or distribute the property arises, whichever first occurs. So that's your test for new types of property. You've got 3 different triggers you can choose from, but whichever first occurs is the proper trigger. So that concludes the 201 segment. Let me see where we are on our time. I'm probably over it because I'm pretty long-winded. Sorry, get to the agenda page. Okay. Actually, I'm under. Wow, that's amazing. So I've got 3 minutes left on my time. Does anybody have any questions, or we can break? I can give you 3 minutes and we can get some Danishes and cookies. Yes, sir.
As you mentioned, a lot of things are auto renewal, distributions go ahead and auto reinvest. That in combination with paperless statements, how is the world adapting to actually knowing, because there's not interaction required, and someone could have fallen off, passed away several years ago, or they could just be, no, this was my intent. I chose paperless. I wanted these things.
Yeah.
How do you fight the balance on that?
Yeah, and it's the owner's option to elect paperless. But if you can see that they haven't opened up an email that you've sent, and I'm assuming you're tracking emails when you're sending out statements by email, if they aren't opening those, or they're coming back, or being returned or rejected, cannot send or cannot deliver, then we would expect that you would default back to paper in that instance. And then if you're not, if there's RPO through the mail at that point, then it would be considered lost contact. Does that make sense? Cool. Any other questions? Yes.
Quick question. I do work for a bank,
That is an excellent question. She asked, would a dividend check fall under the all other clause or would it fall under something else? And in my opinion, in my unofficial opinion, because I'm not a lawyer, it would fall under the all other clause. And you would have the three-prong trigger, and it would be the earlier of the date, because it doesn't necessarily fall under any of the other ones specifically. Any other questions? All right. Kurt, we can wrap up the online portion for a second and go to break and give you guys a few instructions or a few heads up. We've got a bathroom. If you go down to the end of the hall and hang a left towards the elevators, there's a bathroom right on that hall if you need it. There are, if you want a soda, there are vending machines down on the second floor. For each session coming up, we're going to be passing out just a sign-in sheet each time, just because we are offering CPE credits. So if you would just sign in each time, that way we know you're here. But if you have something that comes up that you need to leave, we will offer partial credit. So just check in with the desk up front and just let them know you're going to leave for a little while or you're going to come back, or just keep them in the loop so that we know that we can offer you three credits instead of 4, or 1 instead of 4, or 1.5 instead of, you get the picture. But if you have any questions that we haven't answered up here, or questions that you don't think should be asked of everyone, anyone with a one of these on their jacket or on their uniform, that they work for us and are very welcome to answer any questions, and we'll be walking around mingling, and just feel free to ask anything.
Hi, I'm Auditor State Dennis Milligan. Do you have unclaimed cash? The Great Arkansas Treasure Hunt is in full swing. There are over 1 million properties worth over $400 million. 1 in 4 Arkansans has money owed to them. It could be anything from jewelry to baseball cards to cold hard cash. Go to claimitar.gov to see if you have unclaimed property. Hi, I'm Arkansas Auditor State Dennis Milligan, and this is Bob. Bob has unclaimed cash in the Great Arkansas Treasure Hunt.
Wait, really?
Bob's been sent a check without doing anything.
We have cash?
The state legislature passed a law that allows me to send him a check when his data matches our unclaimed property.
Hey, we have cash!
Keep your eye open for a letter from me. It might be your lucky day, just like Bob.
All right, guys, we are back. Kurt, are we live? Awesome. All right, so we're going to jump into session 2, and in session 2, we're going to jump into how can a business submit an unclaimed property claim? Guess what? We're going to try to get money back to you just like we're telling you how to report it. So to present that, we've got Curtis Irvin. He's our Assistant Claims Manager, Level 2, and he is great at talking about how to claim property, and I'm excited to hear from him. He's been working for the office longer than I have, and I've been in the office for over 18 years. He started out as an intern in high school and has just stuck with it, and we are so thankful to have him. Please welcome Curtis Irvin.
How's everybody doing today? Everybody doing today? Doing great? You're happy to be outside of your office, be somewhere else where you can kind of get a little break. But first of all, I want to thank God. I always got to give God praise and glory for being here. Everyone give me an opportunity to just be here on this stage. I've been with the office for a while. Like you said, I've been here since I was about 15. So I've learned so much, but I see that I learn something every single day. I learn something every single day. That's one thing I tell myself. Every day is a new learning experience. So whatever I learn today, I can learn something that following day. So I want to first ask, is anybody like money? Raise your hand if you like money. Okay. Well, we're first going to go over a website that you can go to. It's not our website yet. We're going to go over there next, but I have a website called missingmoney.com. Missingmoney.com. It is endorsed by NAPA, National Association of Unclaimed Property Administrators. So that's a website that you can, and how many people have possibly lived in multiple states? Multiple states, okay. So when you get your lunch, you may want to, while you're eating, you can go to missingmoney.com and search for different state unclaimed property divisions. Their websites are on that portal, And so if you've lived in other states, most states are on there. So you can check on there if you've lived like in Chicago or live any other place besides Arkansas. You can check on there and see if you have unclaimed property in another state. Now, I know I'm talking about business, but I want to put that out there for individual money. So you may work for a business, but you like, what about my money? So I'm like, so that's something that you can go to and search. See, I got my clicker. I guess the clicker's not on there. And I'm gonna go to the next one. Okay, so what documents do I need to file a business claim? So if you guys go on our website, in which I'm gonna go over there a little bit later on, it's claimingAR.gov, and that's gonna be on a few slides coming down. That's our website. You can go and search for Arkansas unclaimed property. So if you have a business in Arkansas, in most cases, the holders, as Josh went over, most time they're going to submit all that unclaimed property to the Arkansas Unclaimed Property Division. So you want to first know how to file a claim with our office. First thing you need is a claim form. So you can get a claim form by calling our office, or you can go to our website and generate one. You can generate a claim form. Now keep in mind, we do have electronic filing, but unfortunately business claims are not eligible for electronic filing. So with that being said, you would have to print that claim form off and provide a little bit more information. So on your claim form, you'll need to complete it. You'll get a claim form from us, and you'll be able to put your signature on there. So if you're someone who does all the business work or claims money, or the treasurer or whatnot, or somebody appoints you to be over claiming unclaimed property, you basically would get a claim form from us, and also you would sign the claim form. Now, if it's over $1,000, you would have to get it notarized. So if you have a notary, you can get that notarized. And so we'll move on to your next thing you'll need. You'll need proof of identity. So we know you'll need a copy of your FEIN number. So make sure you include that with your claim form. You'll include your claim form and your FEIN. So you can write that pretty much on our claim forms on the far right side. They have where you can put your social security number or your tax number on there. So you'll put your FEIN number on there. Next, authorization to claim. So basically, we want to know. We don't want to. I mean, a lot of people that when they submit their ID, I see they're redacting their, address and all this stuff. I was like, no, we're not trying to, mess with you or come to your house. And I understand. One of those things is just like, hey, we get them all the time. We get claims where the address is redacted. Like, I don't want you sending this to my house, but we're going to basically send it to the business. So we just need identification. So in previously, we used to just have where someone signed off, like a CEO would sign off saying this person has authority to claim. But we want to also make sure that we have a face with the signature. And so we would love to have the ID as well. Sometimes we do take IDs or company IDs. So if you have a company ID, you can submit that with your claim. And next, like I was speaking about, letter of authority. So that basically is a letter that gives you authorization to claim on behalf of the business. So if you work for a business, and we want to make sure that you are authorized to claim. No, you don't want anybody just claiming for a business. So the auditors look at that information. We just want to make sure who you are. You are who you are when you're claiming. In most cases, that will be a letter that's written up by either your superior or someone just basically stating that you are authorized to claim on behalf of this business. A proof of address. So proof of address, in most cases, what consists of proof of address? So if there's an address that you're currently at right now, the business location, you can provide like a current statement, like utility deposit, or just sometimes we can go to the website. If you're at the same address that we're receiving the property, I mean, we don't know why it would be unclaimed if it's still the same address, but we still get money that's still at the person who's at that address. It has their current address on there. So if that happens, that's fine. We were able to prove that old address simply. So tax documents, like I said, utility bills or bank statements, you can provide us to prove that old address. Okay, so in some cases, now with closed businesses, basically this is touching bases on probably if you have an individual business or if you're with an entity that is closing, you're gonna have to provide documents, and I'll speak specifically just for business owners. If you're a business owner outside of your job, if you're a business owner and you may have unclaimed property on our website, you may want to find out, since we're not going to be paying the business, we'll be paying you individually, what documents do I need? So, of course, like we discussed earlier, you'll need your claim form. You'll need another claim form. You'll just sign it, just like I spoke about earlier. You'll sign that claim, and you'll send that in as well with an ID. Yes, with an ID. So with this, what I would say with individual business claims, the key is to go ahead and send in. Now with open business, if you're just claiming for a business or your individual business, we would just basically need a tax ID number, FEIN number. But in this case, since the business is closed, we'll need to know who's the owner of the business. So if your percentage, or if you have a percentage in a particular business, we'll also need to have a copy of your Social Security card or Social Security number. And also you can include a copy of your tax information as well. So regarding that, if you have dissolution documentation, that's going to be very helpful. That goes a long way if we have any type of last federal tax filings that let us know when you filed last, and in most cases it would tell us or give us identity who owned the business or who had a share in the business. If you're INC or LLC, we can get identification from SOS, or we can get your current tax documents that's going to be able to help us to determine who was the owner, or if you had a partnership or sole proprietorship. In most cases, some of that information is filed with your main taxes. So that information would be helpful to provide to be able to help your claim process go by smoothly. And also, just as like I said, as simple as it is, providing proof of the old addresses, providing proof of your address showing that you are at that address or previous address. In some cases, your business may have been closed for a long time, and sometimes I know we've worked many claims that it's like we've been there away for about 30 years or 20 years, and sometimes it's hard to find proof of old address, especially, and that's one of the toughest things. But try your best providing any documents that you have to be able to tie you in with that business, and other information that you may have to tie you with that business to help us pay the owner. Okay, so how do I submit an unclaimed property to the state of Arkansas? So best way to do, like I said, if you see a claim online, you can go to our website. Like I mentioned earlier, it's claimitar.gov. Claimitar.gov. You can go and search your property. You just type in claimitar.gov, and once you click on there in the far right, you can be able to search for unclaimed property. And basically, when you search, we have a tab right on the far right that will allow you to search for unclaimed property. And once you hit on that tab, you'll be able to drop down and search. And this is not limited to business claims. Like I said, you can also do your own individual claims. So if you find money today, let me know so I can help you with the claim process. So I didn't want to just make this limited to business since I'm up here. So, and yeah, you can go to our website, claimitar.com, and you can file your claim. Like I said, now for owner claims, if you do find property on the website and you're the sole owner of that, you are eligible to be approved electronically. So this is only that, and I know I'm talking about business, but I just want to throw that out there. If you do have an owner claim, you could possibly be approved online. If you're not approved instantly, then the claim form will be emailed to you based off the email address that you provide, and then we'll be able to process that based on once you send that information in. We do have a uploading portal that you can go to on our website, and also you can mail it to us at 1401 West Capitol Avenue, Suite 325 in Little Rock. So that's another option. But if you just want to submit your stuff as fast as you want, just email it to us and we can get it like that. And I think, yeah, so just basically just kind of have some screenshots of showing where you can go to our website. And if, like I said, I'm here if you have any questions regarding that, we can help you with that process. And yeah, so if anybody has any questions anytime, you can ask me. Thank you, Josh, and everybody for giving me this opportunity. Does anybody have any questions about unclaimed or business claims or owner claims? Okay. Well, thank you guys so much. I appreciate you.
All right, guys. Well, I get the pleasure of teaching you how to fill out a holder reimbursement claim, and this should not be confused with a holder reimbursement claim, but a return for an errant payment. And I'm going to start out with a holder reimbursement claim. If you, as a holder, are contacted by an owner or an apparent owner that you believe you could send the payment directly to them, you can claim to get that money back from us. Now, in order to do that, you have to show proof that you return the money or return the property to an account for the owner. Give us that evidence along with some of those documents that Curtis talked about, say a copy of your ID, copy of your business card, and a completed claim form. I'll show you the claim form in just a minute and show you the differences on how to submit that. But those are the main things that you have to provide us to get that money back. Before you start that process, as some of you may be aware, check with us before you start with it to make sure we haven't already paid that property out. Because if we've paid that out and you reimburse, you pay it back to them, they're getting the money twice, but you're going to be out that money because we can't pay on something we're not holding. So be careful there. Just contact our office, contact Curtis. He loves those questions. And he can check in our system to see if it's still available. And then you can go through the steps of getting the money back to them and submitting a claim. Now, once you get it back to the person, don't wait 6 months before you file that reimbursement claim, because you may give it back to them. Curtis has told you, say on July 1, that it was available. So you reimburse them, but then 6 months later, that person has claimed the money and gotten it. We don't put a hold on it. We can't do that. So make sure that if you're going through that process, you've got a quick turnaround to be able to submit that claim so you can get it back from us. Now, can you go to the next slide, please? Now, alternatively, during the holder reporting process, you may have submitted a payment. And let's say you submit a report and automatically submit a payment right after that. And then within probably half a day, you get notification that your report was rejected because some of that property was due to other states, or you needed additional information, or there are so many different ors that could come up that basically the ending report that you submit is less than what you submitted the payment for. there is a mechanism that we can use to allow you to get that money back. Really, the form is required because we need to confirm that we're sending the money back to the correct person or department, because the reporting party might not be the person at your organization that the payment should be delivered to and should be handled by. So we need you to confirm that information for us. The form for each of the scenarios, reimbursement claim and return for errant payment, is the same form. We just use the same form because it can be used both ways. But for a reimbursement claim, we do require a notarization, and that it be signed by an employee within the organization. It can't be submitted by, say, a third party. It has to be somebody in the organization. So in a scenario where I don't want to pick on any one company, so let's say ABC 123 Company outsources all of its handling of, say, dividend distribution or something along those lines to, say, an XYZ company, the Computer Shares or the AST or the Wells Fargos of the world. But the ABC 123 Company has to fill out the reimbursement form to be able to get that money back, because we have to deliver it to the holder. Now, the scenario that I just said was probably not the best one, because a transfer agent can be considered a contingent holder. So they could actually fill out the reimbursement form. But in some circumstances, a holder reporting company, a Savos or TPG or a different company like that, companies that are assisting you in reporting, they wouldn't be able to do that for you as the holder. You're going to have to essentially sign that form to get the money back. So can you skip ahead to the actual form, please? One more time. Okay, the forms can be found, the reimbursement form or the form for return can be found in our forms library, auditor.ar.gov/forms-library. Click. Once completed, if you're submitting a reimbursement claim, you'll need to send that to a different place than you send a request for a refund. The reimbursement claim is an actual claim for property to be paid, and it's reviewed by our claims team. So it needs to be sent to claim it at auditor.ar.gov. If you inadvertently send it to our holders team, we will, of course, forward it. But it would help if you send it to the correct parties. Click on the next one. Okay, this is what the website page looks like in our list of forms. There is a link for instructions on how to submit a reimbursement, and then there's a link for the actual form. The instructions for the reimbursement are not the instructions for the return. Those are in our report of our unclaimed property reporting booklet that's on a different place in our website. You can find instructions for how to submit that. You click to the next one. This is the actual form that you'll be filling out. On here, you'll need to make sure that you put the name of the holder, who you need the check made out to. So If it's Department XYZ and instead of Department 123, make sure you put that on there. Confirm the address, city, zip code, state for us. Confirm the proper tax ID number for the company that you need us to send the check to. Not necessarily to the company that the tax ID number that you're reported for, but the tax ID number that it needs to go out to. Because we have to, I don't know if you're aware of anti-money laundering laws. I'm pretty sure that most of you are. We have to have a tax ID number to be able to issue a check. So then give us a telephone number, contact name, email address for the person that we need to get in touch with if there's any questions that we have about issuing this check. Then tell us if it's a reimbursement claim, you'll tell us the date it was reported, identify the property that we're returning to you in that section 2. If it's a refund, you can skip section 2 altogether and just go straight to that question. If an amount was returned in error, please explain. And that's where you tell us, guess what? We submitted a report and we issued the payment before the report was accepted, so there's a difference in the amount. Can you return that to us? Great, that's what we need. For a reimbursement claim, it is a claim for unclaimed property. So we have to have a notarization, and it has to be signed by an employee in the agents in the organization, signed in front of a notary. If it's a refund, all we're doing is confirming that information. I don't need a notarization for that. Because, long story short, if you don't fill this out and we're holding this money, we're not going to hold this money any longer. We're going to send it to whoever we believe we can send it to if you don't fill out the form, because we can't hold it. So if we send a refund check out and within a year or within 180 days you haven't cashed that check, it's going to go right back up on our website as a report that we issued a check and it's unclaimed, so now it's available to this company that we sent the refund to. So that's another way to submit to claim your unclaimed property from our office as a business claim that Curtis just went over. So there is a cycle for it. But that concludes my section on this part of it. Does anybody have a quick question? But I want to give Shawn enough time to talk about our voluntary reporting programs. So does anybody have a quick question, or can I just kick him off? Nope? Cool. All right. Shawn Hibbard comes to us all the way from the East Coast. He's with Kelmar Associates, one of our auditing services providers, and Kelmar also provides our system support for how we hold property and other things. He has been an audit supervisor or the like for more than 20 years. He has a long breadth of understanding of unclaimed property, how audits are performed, and all of that. So please hit him with all of those questions during breaks. If he hasn't slinked off, which I would if I were him. But Shawn is going to talk to us about our voluntary filing options. Please welcome Shawn Hibbard.
Thanks, Josh. Hi, everyone. Okay, so today we're going to cover how you or your company can become compliant with the unclaimed property laws. There's a couple of different questions that we seek to answer. A, How can your company become compliant? And then how can you report late without penalty? Big question is kind of where do you start? I think a lot of companies, they're not aware of the unclaimed property laws, or maybe they're aware, but they've never done the deep dive to really understand what needs to be done. Certain states, they have interest in penalties attached to reports. Arkansas provides you with multiple different options. We'll review those today, and gives you an opportunity to avoid penalties and interest. Next slide. Oh, if you go back one. Thank you. So here are the big three, the three options that you have: a voluntary compliance agreement, otherwise known as a VCA, a voluntary disclosure agreement, a VDA, and then a voluntary review. All three are good options. Some you may think that are better for your organization, and that's something that you can discuss with the division and their team. Next slide, please. The first question, I think the most important question, is are you eligible? And I'll read this because the details are important. The holder represents it's eligible for participation because the division or a third party acting on behalf of the division has not contacted the holder to determine compliance with the law, or has otherwise been approved by the division, or the division or a third party acting on behalf of the division has contacted the holder to determine compliance with the law, but the holder has received written approval from the division to comply voluntarily. It's a lot of words. I think what's important here is if you're interested in coming into compliance, reach out to the division, communicate with them, let them know your situation, and you can talk about what makes the most sense. Next slide, please. So the voluntary compliance agreement, this one is holder guided. Again, you covered some terminology earlier today. The holder is you, so you would guide this effort. Support, questions, whatever you have, you can reach out to the division and they'll provide that to you, Josh and his team. You'll be reviewing your books and records for a period of 10 report years. You'll submit that report including all past due property. As been covered a few times today, it's very important to include all of those different details: property owner information, tax IDs, property categories, addresses. All that information is very important, as the ultimate goal is to reunite that property with the owner. You'll report and remit within 6 months. No penalties will be assessed. And then you'll continue to report on a prospective basis and retain your records for your report and your property owner information. Next. There's a little bit of repetition here, so bear with me, and then I'll cover the differences after we go through them all. The voluntary compliance, or excuse me, disclosure agreement, this is a vendor-guided process. So I'm one of the vendors, I'm Kelmar, there's a few other colleagues that have spoke today or will speak later today. We help guide this process, and there are some other vendors out there. We'll provide that support and education, but at any time, if you have questions, if you wanted to go directly to division, they are there to help, and you can do that. Review books and records for 10 years. Report with all past due property, all that important owner information. Slightly different, but you'll report and remit in a timely manner. Generally, how we handle it is we develop a work plan. We'll communicate with you, have a conference call, and say, let's talk about what you have, what property categories, how complex is your organizational structure, and we'll come up with a work plan to scope the entities, to gather records, and as long as it's a good faith effort and it's being conducted in a timely manner, the division will give us the thumbs up. We'll have an approved work plan, and we'll work off of that to complete the process. Again, no penalties, and then you will continue to report on a prospective basis. Next slide. And then a voluntary review is the third option. This one is guided by the division. It starts off slightly different than the other processes. You'll provide your reporting history, should one exist. and other relevant information to the division. It could be scoping documents. They'll give you an idea of the type of information that you need to provide. You'll kick that off, provide that information to them, they'll evaluate it, and then they'll kind of provide the roadmap from there to work you through the process. They're providing that education, reports, review your books and records, 10 years, consistent theme here, reporting all of that past due property, no penalties, and then you'll continue to report on a prospective basis. So just to cover the key differences, I know I said the same thing a few different times. The VCA, that's guided by the holder, that's you. The VDA, that's guided by a vendor like Kelmar. And the voluntary review, that's guided by the state or the division. If you could jump back on that one. Thank you. The VCA, you'll complete that within 6 months. The VDA and the voluntary review, again, you'll work out a work plan with either the vendor or the division and go through the process there. The two agreements, the VDA and the VCA, there will be a signed agreement in place saying that you'll go through the process, that you'll report and remit. For the voluntary disclosure agreement, you'll respond to the request from the vendor. So there might be some questions, some validations that need to occur. You know, have you reviewed your books and records? Can you provide a overview or an inventory of the records that you reviewed? And that information would be provided. And then in the case of the voluntary review, you'll provide the reporting data to the state on the front end, and then they provide that roadmap for you to complete the review. Next slide. Question, how do you apply for these voluntary reporting options? Communication is key. Reach out to the division. You can see holders at auditor.ar.gov. Contact them, let them know where you are in the process. If you have a preference on a particular type of voluntary compliance review, you can let them know, and they'll also provide their opinion on what might make sense for you and your organization. Next slide. So we talked about different voluntary reporting options. I wanted to talk briefly about something else that you may see. My background, I've worked for Kelmar for about 20 years. The first 15 years I worked on our audit side of the business. Over the last 5 years or so, I transitioned to the self-review or the self-audit side of the business, and we perform those services for a lot of different states. The goal of the process, you can't audit everyone, obviously, so the idea is that you perform some outreach to companies in a particular state, show them the unclaimed property law, teach them, educate them. So what that could look like is you may receive an email or a physical letter in the mail, and what that letter or email will instruct you to do is to go to a website. It's through the State of Arkansas website, and there's a drop down and an outreach response area. You would go there, drop in a reference ID at the top of your letter, and you'll provide some contact information. Basically, what the letter is asking you to do is perform a self-review. And so that contact information will allow our team or one of the vendors to reach out to you and get the process started. There's a few different reasons why you might receive this letter. You know, if you've never filed unclaimed property reports, obviously that could be a reason. If you have inconsistently filed unclaimed property reports, and we've seen this more probably in the COVID era or the post-COVID era, where there may have been a process in place for a number of years, maybe reported in 20 and 21, and then say in 2022, the report stopped and they didn't see anything for 2022 or 2023, whatever it might be. So there are some gaps in the reporting history. That could be a reason why you get a letter. Or in some instances, you filed a report, but not for all of the different property categories that would be consistent with your industry. So maybe you're a manufacturing organization and you file payroll. That's great. Traditionally, manufacturing organizations will file things like vendor checks, accounts payable, customer credit balances, things along those lines. So if you receive that letter, that could be why. If you have questions when you receive that letter, certainly just reach out to the vendor. They can have a discussion with you about your reporting history, let you know why you may have received that letter, and then work with you to get you back into compliance. It's a vendor-guided effort, and the different requirements are really acknowledging receipt. Obviously, they want to know that you receive the letter. There are some educational materials. I'll show you a few different examples of that coming up. You're performing the self-review. Obviously, the vendor and our teams are here to provide you with the guidance that you need to work through that review. And then you're asked to adhere to a timeline. Generally, they're asking for that review to be performed in 150 days or so. But as it says there, extensions are permitted with cause. If there's a reason why, again, if you have a complex structure, if your records are off-site and you need to call Iron Mountain to gather those records, there can be reasons why, and the division certainly understands there can be circumstances beyond your control, and some additional time can be added to assist with that process. So these are just a few examples. I won't spend too much time on these, but these are some of the educational materials that you may receive throughout that process. You're being asked to identify legal entities, kind of perform that scoping. What are the legal entities involved? Many of you, it could be one LLC, whatever it might be. Other organizations are more complex. There could be dozens of different entities in the organizational structure. So once you perform that scoping, you start to identify the different property categories through a review of the general ledgers. Then you need to identify the different source records that are available to determine if there are past due properties on your books. You perform that review. Internal research typically happens first. You can look, if I would use, you're looking 5, 6, 7 years back, you look at a voided check report and there's a block of voided checks on there. You'll want to understand internally if you can determine the outcome of those. So maybe that voided check was voided and then reissued at some point in the future, that it was a payroll check, whatever it might be, and ultimately that payroll or those funds were returned to the employee on a future check. Okay, that item's fine, take it off the list. So you're really trying to whittle down that population of potentially unclaimed items through your internal research. Once that piece of the process is complete, you'll perform due diligence. I think that's been covered in a few different presentations today. That due diligence, you'll get outreach out to those potential owners, let them know that you have the property on hand, provide some details on the property, let them know that it is going to be turned over to the state if they don't provide that information. And then you'll wait for that response, and then hopefully you get it. You can reunite those owners with the property, and in the event that you cannot, that property will be turned over to the state, and you'll go through the same report and remit requirements that were covered in the slides earlier today. When is property reportable? I think you touched on this before as well. But I think the main point here is this is another one of those educational resources that are provided by either the division or the vendor. There are 1-year properties, payroll, for example. There are 3-year properties, customer credit balances. There are 7-year properties for money orders. There are some different rules surrounding unclaimed property, and our goal through this process is to educate you. And I think one of the most common questions that we get, holders will ask us to really put up the fence posts and help them understand which transactions do I actually need to review. So this, you can see on the left-hand side, we break out the exact issue or last activity dates that you need to be looking at, and we provide the same educational materials for the 3-year properties, the 7-year properties, or whatever it might be. Next slide. And then, again, just a final piece of educational material. A lot of different industries are represented in the room here today and online. You'll want to know what property categories are common for your industry. So we've provided a lot of examples here. Payroll's kind of common across the board, accounts payable, Do you have customer credit balances? Do you have money, or sorry, you're financial institutions and you have IRAs and some other property categories that were covered. So like I said, if you do receive one of those letters, don't be scared. We are here to help. The division wants us to reach out to you, develop a relationship, communicate, and really help you work through the process to come into compliance. So I think that's it for me. Everyone can have lunch. Are there any questions about the different areas? Okay. Thank you.
Thank you, Shawn. That was amazing. I always follow up this presentation or this little segment and say, hey, we want to work with you. If you have a question, if you have a scenario, don't feel like you can't reach out to the state. Call us. We're people just like you are. So if something's not working or doesn't make sense to you, I mean, just like any other, say, IT request or something, you may have to dot all the I's and cross all the T's just so that we get the big picture. But we want to hear from you, and we want to help you, and we have these programs just for that reason, so that, hey, all of us make mistakes. Well, and I'll ask you a question. By raise of hands, who in this room or who online, except for God, who is perfect, who has never made a mistake in their life? Oh, wow. Yeah. I usually get one smart aleck person at the back of the room that raises their hand, but I didn't even get one. But yeah, that's right. Nobody's perfect. No company is perfect. No state is perfect. Nobody is perfect. So just like we're not perfect, we know you're not perfect. We have these get out of jail free programs that are set up so that when things don't go the way that they're expected, there is a way to fix it. And it's not penalties and interest and audit and different things like that when you can mitigate it yourself. Now, if we see there's ongoing problems, you'll see in one of the little snippets during the middle, we've got over 190 ongoing audits right now. So there is a mechanism to follow up with compliance as well. We don't want to automatically go there. We want you to be able to fix it yourself. But we're here to answer the questions. Our auditors are people too, and they can work with you on what type of documents are required as proof to a certain record or different things like that. So, and I'm not an auditor. I'm not a lawyer, so I'm not going to speak too much to that. I'm going to leave that to the professionals. But our time, we have about 4 minutes left. If anybody online wants to send me a question to my phone number that I sent you in a link or in an email earlier this morning, feel free now. And if anybody here in attendance wants to ask a question, I can answer. All right, Mom's word. Cool. Let's go ahead and I'll give you 3 minutes of your day or 3 extra minutes so that you can get a lunch, and we'll be back here at, let me confirm. One of you might be able to get to it quicker than I am. We'll be back here at 1 o'clock. Are we off online? Okay. For anybody here, there is a list of restaurants within walking distance on page 5 of the booklet. I'll recommend just about everything on there, especially Lanchera Rodriguez. It's a taco truck that's just a block away. Depending on what you're looking for, Cottom's is great. You can get a big old hubcap burger that you can't eat in one sitting, and they've got great catfish, fried catfish. Capitol Bistro and Subway are Thanks, guys. All right, guys, sounds like we're live. Okay. We get to kick off session 3. Has anybody enjoyed the first 2 sessions? Have you learned anything? Awesome. Well, that's what we're here for. Hopefully, we can all learn something. I've actually learned some things today too. I've been monitoring the cell phone with all of the online questions. So I've been trying to answer as many as I can. Let's see here. We are going to kick off our 3rd session with Andrew Mudgett. He is counsel at Kroll Government Solutions, LLC. Mr. Mudgett is an attorney with many years of experience in unclaimed property examinations. As counsel, too, Mr. Mudgett has been responsible for the legal aspects of ongoing unclaimed property examinations, including the drafting of reports for use by state regulators, negotiation of detailed terms of proposed agreements resolving examinations, and advising the legal department on any legal challenges raised by companies under examination. Prior to joining the company, Mr. Mudgett acquired experience in reviewing financial records and conducting legal research. In addition, he obtained corporate, transactional, and healthcare law experience. Mr. Mudgett is a graduate of the University of New Hampshire and has received his Juris Doctorate degree from Quinnipiac University School of Law and his Master of Business Administration from Quinnipiac Lender School of Business. So please help me welcome Andrew to the stand. Thank you.
Good afternoon. How are we all doing today? Feeling recharged after lunch? Thank you for having me here today. I'm going to talk to you all about a couple different things. I'll start off with probably a lot of overlap of what you might have heard already. I'll talk a little bit about the Unclaimed Property Act for Arkansas, some key dormancy periods there depending on property type, and some recent developments. And then I'll switch gears here and I'll transition. I'll talk a little bit about audit processes and what you might expect if you do end up receiving a audit authorization letter from the state, and typically what process you would expect to experience through there. So generally speaking, as you can see on the screen, the citation for the Unclaimed Property Act is under Title 18, and generally what you would expect to see there are terminology and definitions, presumptions of abandonment, specific citations for treatment of individual properties, as well as some key administrative ones as well, like statute of limitations, the assessment of penalties and interest. It can all be found under the Unclaimed Property Act. So starting with some of the legislative update, if we go to the next slide. So what is unclaimed property? I think by now you've heard a lot about it. I think we're all pretty familiar with it at this point. Generally speaking, it's intangible or tangible property that's been abandoned or lost by its rightful owner for a specified period of time, known as the dormancy period. And up on the screen, you'll see a number of different examples of what unclaimed property is, whether it's savings and checking accounts, including time deposits such as certificate deposits, unpaid wages, commissions, payroll, stocks, bonds, utility deposits, etc. The Act itself does also carve out what is not considered properties for the Act's purposes. And one key distinction here is you'll see in the gift card section is a specific carve out for gift cards that would meet this definition, and that is does not include gift certificates, gift cards, in-store merchandise credits, or layaway accounts issued or maintained by a person in the business of selling tangible personal property at retail. So that is a very specific definition addressing a specific subset of gift cards, issued, maintained by a person in the business of selling tangible personal property at retail. That type, or if you have gift cards that would meet that definition, they would not be reportable. gift cards that don't meet that definition would be reportable under the Unclaimed Property Act. And the gift card distinction is one that you'll also see nuances in for a variety of states. Every state treats it differently, and you'll also hear them referred to as closed loop versus open loop gift cards. Traditionally, closed loop end up being gift cards issued and are usable at an individual seller for their goods. You might think of a closed loop gift card as a Bass Pro Shop gift card, or a retail gift card for that matter. An open loop gift card tends to be one issued like a Visa gift card, or you could even think of a reloadable card, something that's used at a variety of different vendors. That's more of like an open loop, and that is something that you would see not necessarily meeting this definition here as the carve out itself. So what is unclaimed property? Statutorily set period of time where there's been no owner initiated contact or activity that must elapse before a state can consider property dormant or abandoned. This is calculated from a trigger date. And the trigger date itself is something that is dependent on the nature of the property in a lot of instances. Some common examples you'll see are the issue date of checks, the date of last contact or activity, a maturity date, or the date the property becomes mandatorily distributable. One key nuance that I want to point out here with respect to the issuance dates on checks is I think it's important to note, are we talking about an issue date or a reissue date for a check that's ultimately been voided and then reissued? And I think that a lot of times there it's going to depend on the nature of the reissue itself. If your business typically voids after, let's say, 180 days of inactivity and then automatically reissues, that activity wouldn't constitute activity that would restart the dormancy trigger. You would use the original issuance date itself. Whereas one nuance that you might want to consider is if, let's say, you only reissue when somebody requests it and they call in and they say, hey, I never got this check, and you would submit a reissued check because the actual expression of interest in the property. That's one nuance to determine whether, when you're using issue date for checks, whether it's the original issuance date or a reissue date because of somebody requested it, or if you just automatically reissued it itself, would indicate which issue date you would ultimately end up wanting to use. So the dormancy period, generally speaking, is going to be between 1 and 15 years, and it's dependent upon the property itself. Most property types in Arkansas are going to be 3 years, but one big common one that you'll run into a lot, payroll wages, that's 1 year. On the other end of the spectrum, you'll have money orders at 7 years. You'll have traveler's checks at 15. So it's important to keep in mind when you're trying to determine which dormancy trigger to apply, to know which property specifically you're talking about. And Arkansas issues very good guidance, and they have a holder reporting booklet that you'll see the specific property codes and the specific time periods associated with each individual property, whether it's 3 years, 1 year, whatever the case may be. So I'm going to take a moment to talk about some of the compliance requirements pertaining to reporting. So under the Unclaimed Property Act, businesses are required to report and remit unclaimed property to Arkansas annually. Most businesses, you're going to end up having a due date that's actually coming up here for the fall, being before November 1st. And what this covers is a 12-month window ending the preceding June 30th. So the cutoff ends up being July 1st to June 30th. You then have a leeway a little bit of a couple months to end up filing the report for the property that became reportable within that time period. One exception there is for life insurance companies. This is going to be a spring report filed before May 1st, and it's going to cover the preceding calendar year. So it'll use a January 1st to December 31st cycle within a couple months, and then you would follow your report there. Most properties, though, or most businesses, I should say, outside of life insurance are going to be on a fall reporting cycle, meaning that you are working with that July 1st to June 30th window itself. Another compliance requirement regarding reporting is going to be the due diligence process, which you've heard a lot about now. you must send written notice to owners. This applies to properties that are $50 or more. There's a specified window of time before your report would be filed, which I'll touch on in a little bit. That is the required time for when you would send these notices to, or send these notices out. And you would only send these notices if you had the addresses on record and you know that they're not inaccurate records, inaccurate addresses for owners. If you don't have the owner address, you don't need to send the due diligence out. And then again, if it's under $50, you don't need to send due diligence out as well. So I'm going to take a moment to talk about a couple changes to the Unclaimed Property Act. Some of these now you may already be familiar with. There were some dormancy changes that ended up taking place in 2015, 2017. So if have done unclaimed property the last couple of years, you're already familiar with what these thresholds are. If you're new to your position or this is your first time doing unclaimed property reporting and you just found your business's policies and procedures, at the top of a shelf with dust on them, maybe these will, be helpful in bringing you up to speed. But I'm going to talk a little bit about those changes since it is the most current information. And again, I'll talk a little bit about some new developments that have also taken place this year. So as I mentioned, 2015, 2017, there were some modifications to dormancy periods. Not everything changed. I'll highlight a couple of examples, such as bonds, savings accounts, CDs, stocks, demutualization proceeds. These have all changed. I'll also point out, in the next coming slide or so, some examples where there haven't been any changes. But of the ones I just mentioned, bonds was a change from 5 years to 3 years. This property type is defined as debt of a business association or financial organization other than a bearer bond or an original issue discount bond. The dormancy trigger for this property type is going to still run from the date of the most recent interest payment that has been unclaimed by the owner. For savings accounts and CDs, it's also a change from 5 years to 3 years. This is defined as a demand, savings, or time deposit, including a deposit that is automatically renewable. And your dormancy trigger here is going to be running from the earlier of maturity or the date of last indication by the owner of interest in the property. For insurance company demutualization proceeds, another change from 5 to 3 years. You're noticing a trend here. The property type is defined as property payable or distributable in the course of a demutualization of an insurance company, and the trigger is going to run from the earlier of one of two things, the first being date of last contact with the owner, or the date property became payable or distributable. One change that actually went the other direction and ended up increasing instead of decreasing was a change from 5 to 7 years as it pertains to stocks, which I know we talked a little bit about earlier. Stock or other equity interest in a business association or financial organization. The trigger being the earlier of one of three things, which I know, like I said, Josh had mentioned earlier, which is the date of the most recent dividend, stock split, or other distribution unclaimed by owner, the date of the second mailing of a statement of account or other communication returned as undeliverable, or the date the payee is presumed lost under SEC rule. Similar to the trend that you noticed before, for the most part, a change of 5 to 3 years. This also was implemented for what is known as a catch-all provision in the Unclaimed Property Act. Essentially, there's a change from 5 to 3 years for property that isn't specified already in the Unclaimed Property Act. So you won't necessarily see, uncashed accounts payable check listed specifically in the Unclaimed Property Act. It would fall within the catch-all and be a 3-year dormancy period. So unless you're seeing property specifically addressed with a different dormancy period, or you're seeing a specific carve-out for property that wouldn't be reportable, you'd end up using a 3-year dormancy for all of the property types that would fall within this, what's known as the catch-all. And so, as I mentioned before, there were a handful of property types that remained unaffected by those recent changes, those being traveler's checks, money orders, payroll wages. As you can see on the screen, those are some of the key property types that you might run into that should have remained the same from those amendments. So in 2017, there were some updates to due diligence as well as the dormancy changes from 2015. A lot of that ended up having to do with the window that you have to send these due diligence letters before you end up filing your report. So holder must send written notice to an owner not more than 180 days or less than 90 days before filing the annual unclaimed property report. The old requirement was a 120-day and a 60-day window. It ended up just shifting that a little bit. So it's now between 180 and 90 days itself. So what is new in 2025 for Arkansas, though, is, and I think this was touched on a little bit earlier, is what's known as this data match initiative. And essentially, the act amended Section 215 of the Arkansas Unclaimed Property Act, where now the administrator is able to directly pay owners for property without them having to submit a claim if there's a couple criteria that are satisfied. Those being, one, the person receiving the property is named as the apparent owner of the property in a report filed under the subchapter or under the Unclaimed Property Act. Two, the administrator reasonably believes the person is entitled to receive the property. And three, the property has a value of less than $5,000. For amounts that are up to $1,000, there's no additional documentation that you would need to submit. For amounts over $1,000, there's a little bit of additional documentation, but regardless, this enables individuals, not other states, but for individuals themselves, to receive payments directly from the auditor for amounts under that $5,000 threshold without them having to take, proactive action and actually claiming the property themselves. So additionally, in 2015, and some of the dormancy changes under the Unclaimed Property Act, we also had the implementation of the Unclaimed Life Insurance Benefits Act. And this is separate from the Unclaimed Property Act itself, but it works kind of hand in hand with it. And you'll see this in a lot of other states as well. It requires life insurance companies to search for insureds on the Social Security Death Master File, which is essentially a database maintained by the Social Security Administration of basically decedents. And so, like I said, the DMF it's death information published by the SSA. It is separate from the UPA, and it essentially is requiring insurance companies to perform matches of their in-force policies, which I think I mentioned on the next slide here. Yeah, so it's requiring insurers to compare in-force policies, annuity contracts, retained asset accounts semi-annually against the DMF, with the intent of being to match and identify whether any of their policy owners or annuity contract owners are actually deceased. This excludes a couple different types of policies or annuities, one of them being those used to fund funeral expenses. And essentially, though, what the companies will do is they'll compare all their in-force policies twice a year, and they'll send a file out containing the data. They'll match it up against the DMF to determine if anybody has died, and then from there they'll determine whether amounts are actually owed to the beneficiaries or death benefits are payable. If a search cannot find the beneficiary owner, you would then escheat to the state upon the expiration of the statutory time period for escheat. Violations of the Unclaimed Life Insurance Benefits Act are part of the Trade Practices Act, but really what the goal here is to making sure that life insurance companies aren't missing whether payments end up being owed due to the lack of a knowledge of death. So just want to touch on this for a little bit. As it pertains to the Unclaimed Property Act in other states, Arkansas's version of the act is what's known as the 1995 Model Act. Not every state follows that same ultimate framework of an act itself. There are a few different versions. There's a 1981 version. There's recent developments in the 2016 Revised Uniform Unclaimed Property Act. And I'll point out some of those nuances for what's also known as RUPA on this next slide here. But a lot of what you're running into between those variations of the act itself are going to be different dormancy periods for different property types, different treatment for different property types themselves. Some properties may be reportable in some states. There may be nuances where others aren't reportable in those states that might be reportable in Arkansas. I talked a little bit about the gift card nuance and distinction there before. Under RUPA, for example, there's the periods of limitation for the look-back period changes from the 1995 Act, and it also is starting to address new property types specifically, such as virtual currency. That's not to say that older versions of the Act and states that implement older versions of the Act don't account for these property types. It's just they might be handled in a different way because they aren't specifically addressed. So, for example, while RUPA does specifically identify virtual currency as a property type, Arkansas is able to take the proceeds of virtual currency, and by virtual currency I mean Bitcoin, crypto, those types of currencies. Arkansas just can't take them in their native format. You would have to liquidate the property, and then the liquidated proceeds would then be reportable. So it's not that the states that have some of the older versions of the Act, you're unable to account for some of these other property types. It just may end up being a little bit of a gray area when it isn't specifically addressed in the Act itself. So, all right, so it looks like part of that last slide may have ended up being cut off, which is fine. Essentially, what I wanted to take a moment to talk about is what is commonly known as the MoneyGram case from 2023. The Supreme Court ended up looking at specific properties that were reported all to the state of Delaware and determining whether those were appropriate locations for the reports to be, or for the property to be reported to. And essentially, the question for those specific property types is whether the jurisdiction that they should fall within was, or the purview that they should fall within for reporting priority rules was under Federal Disposition Act or the Federal Disposition of Abandoned Money Orders and Travelers Checked Act, which essentially sets aside a different priority rule or reporting state that you would use for very specific property types. Traditionally, in unclaimed property, the priority rules are established via Supreme Court case Texas versus New Jersey, which establishes that the first priority rule is that you would report to the state of the owner's address. And the second priority rule being, if you don't have the address, you'd report to the state of domicile of the holder itself. Under the Federal Disposition Act, it considers money orders, traveler's checks, or, quote, other similar written instruments. And for those specific property types, it would be the place of purchase, and the reason being the nature of those property types ends up being one where you don't necessarily have an address in when those are purchased. It ends up being a specific subset of property that isn't as conducive to following the traditional priority rules under Texas versus New Jersey. So essentially, in MoneyGram, the question was Delaware as the state of Inc. the proper place to report MoneyGram's specific instruments, and or should they have fallen under the purview of the FDA and report to the state of the place of purchase? And ultimately, what was decided is that the disputed instruments were similar to money orders in function and operation, and therefore subject to the FDA. This entitled states to amounts that were originally escheated under Delaware under that second priority rule. And in determining this, the court established a two-part test for factoring in when an instrument is covered under the FDA. And that is it a prepaid written instrument used to transmit money to a named payee? And the second prong being an equitable prong. Could applying the priority rules of Texas versus New Jersey cause disproportionate escheatment to a bank's state of incorporation due to record-keeping gaps? To my point before about how a lot of times addresses aren't collected necessarily when purchasing money orders or traveler's checks. And so the takeaway from MoneyGram is relatively limited because it essentially is creating a little bit of a gray area. The court decided that MoneyGram's specific instruments were similar to money orders and therefore would fall under the jurisdiction of the FDA for priority. But that being said, they declined to weigh in on defining what a cashier's check is, or defining these broader applications of what instruments might be that you're running into. And so, like I said, while MoneyGram's instruments were determined to fall within the FDA, the court didn't weigh in on the definition of cashier's checks or certified checks. And it really, what this does is it leaves room for interpretation when an instrument should fall within the FDA. i.e. whether some of your instruments should follow the Texas versus New Jersey priority rules or the priority rules on the FDA and go with the place of purchase. And like I said, it remains a little bit of a murky gray area because they had narrowed their decision to apply specifically to MoneyGram's instruments, but it's one important aspect to keep in mind when looking at your own instruments and determining whether they would be, quote, similar written instruments to a money order or a traveler's check. And what it comes down to is a little bit of a fact-based scenario for applying that two-part test and determining ultimately where they should be reported. So before I switch gears and touch on some of the audit processes and what you might expect if you were to receive an unclaimed property authorization, does anybody have any questions about the Unclaimed Property Act itself at this time? Okay. Okay, so from start to finish, ultimately, here's what I'll be talking about when I'm talking about the audit process. It's going to be a general overview of the different examination types that you might experience. And then from there, from the beginning, from audit notification to closeout of an examination and final report issuance and what you might expect to see as part of that process. And so essentially the three different examination types you're going to run into are what's known as a desk audit or a holder self-audit. This is an audit where it's an expedited timeline. The state has oversight and review of the audit, but as a self-review, you're really running through your own records, identifying if there's anything that should have been reported, and in turn doing so as you work through and complete the examination. Separate from a desk audit, one step up, you'll have the state that would issue and run a full-scale audit. That's where state auditors are completing the audit. They're issuing data and information requests and requesting different audit documentation and supporting documentation. And one step beyond that is what's also known as a third-party audit. And essentially, this is where the state is conducting that full audit, but using third-party auditors to complete it on their behalf. And it's the third-party auditors that are sending out data and information requests and reviewing the audit documentation, and then ultimately reporting back to the state, at the end of the exam with what findings are. So the start of the audit begins with an initiation letter that a company might receive in the mail. This initiation letter is going to outline a general overview of the scope of the exam. It won't necessarily identify the look-back period, but it's going to identify the entities included in the examination. It's going to describe the types of unclaimed property that are to be looked at, whether it's pursuant to a specific industry or if it's a general ledger, just all unclaimed property. It's going to outline that for you. It'll also describe a little bit of the time period covered by the examination. Some of them may have a look-back period. Some of them may identify, language saying just pursuant to statute, whatever the case is. And the initiation letter itself is going to identify the relevant context that might be beneficial for you on the state side, but then also the authorized third-party auditor. And from there, an opening conference would essentially be set up. This is the first step of the examination. This is where a high-level overview is going to be provided on what to expect in the examination from the states that are participating. If it's a multi-state examination, there might be multiple different states participating, not just Arkansas. It's going to outline the property types that we'll be looking at, specific company subsidiaries, and a look-back period. One note about the company subsidiaries is that during the opening conference, it's going to be relatively broad. It may address a parent organization and say something like, and its subsidiaries and affiliates. And then as the audit goes underway and initial documentation requests get sent out, it may become apparent that specific subsidiaries are scoped out of the agreement because maybe they're just holding companies. It all just kind of depends on what operations might look like. So it'll start off relatively broad, and then it might narrow down significantly as the audit begins underway. As I mentioned, we'll have examination contacts in the opening conference as well. This is going to include an audit manager that's running the operations on an exam. This might include legal counsel who will handle the negotiating of any non-disclosure agreements or addressing any legal questions that come up. And it'll also provide the state contact information where if you have any issues or if you do have any questions in the case of a third-party authorized examination, that the state contact is there for you to reach out to if you feel that you need to. So during the opening conference, we'll also be describing different audit procedures and what you might expect. This includes the data requirements that will be required, whether there will be any on-site office space that's required. Largely these days, a lot of examinations can be completed completely off-site. There are certain instances that it might make sense to do on-site, but this is something that will be discussed on an opening conference as well. And as I mentioned briefly before, we'll also talk about a non-disclosure agreement and make sure that something like that is in place. Following the opening conference call, we'll send one of those out. It's a non-disclosure agreement between the holder themselves and the third-party auditor to protect any confidential information of the holder. One of the things that we'll also talk about are document and information requests. These are proposed response dates, the types of documentation or the types of information that's ultimately being requested depending on the actual number of the request. One administrative piece that we'll talk a lot about as well is data security and making sure that the data that you would ultimately be submitting and responding to is protected, and that you're aware of that we take data security very seriously in this field. We'll talk a lot about encryption of personally identifiable information, not submitting any data via email and setting up a secure transfer portal, something to that effect to make sure that all transmissions are secure. And then we will also be talking about what reporting looks like in the exam itself. And so this is going to be a process that ultimately evolves over the course of the examination. If there's any past due properties that are identified, what requirements are needed before they can be reported through the exam, and so on and so forth. This is all kind of from the opening conference, a high-level overview as to what you can expect. And last but not least, we'll also be talking about the conclusion of the examination and what you can expect there, such as how to deliver the property, instructions for how to do so, how you can review and reconcile any potential populations of past due property that are identified, and making sure that we're all on the same page and that you ultimately are reporting what's actually past due property, not something that would be necessarily disputed. Following the opening conference, we'll also be sending a follow-up letter that memorializes much of the discussion. It includes applicable state attachments that are required from the states themselves, state contact information, applicable, Unclaimed Property Act citations, whatever information that you'd be able to find or would need or want to find during the audit that we're talking, kind of in the abstract about, we'll have it there for you in the follow-up letter as well. So data requests will initially start off pretty standard, and then depending on the audit itself may then ultimately end up tailoring to your company. Some of the initial requests will include policies and procedures, administrative data. It'll also include timeframes from when to respond to these. That being said, with respect to timeframes, we tend to be pretty flexible and trying to work with you. We understand that some of these data requests may require you to talk to people from certain departments that would be able to pull the information for you, and you might not necessarily be able to do it all yourself. So we try and work with you in that regard on an administrative note, particularly since we understand that you're also running a day job in the midst of an unclaimed property audit as well. Some examples of these initial requests are going to be if you have any policies and procedures pertaining to unclaimed property generally, If you have policies and procedures pertaining to any specific types of unclaimed property, such as uncashed checks, whether you have a procedure for automatically reissuing checks, like I mentioned before, those types of things, any prior reported unclaimed property that you've submitted, and a breakdown of some of your administrative systems, so we know generally how centralized are we working with here for data pulls and some of the more administrative pieces that will make sense as you start to get into the weeds and pulling data. So once we submit requests pertaining to specific property types, whether it's disbursements or accounts receivable, you go back and you pull the data. You would then submit the data over, and essentially what then happens there is an analysis of the data, and essentially we're looking to determine whether there's any unclaimed property that's within the data itself that hasn't yet been reported. Be looking at the records that you've maintained and that are available, and determining whether any of those properties should have been reported on a prior report. Once data gets sent over, a data intake on our end ends up taking place. We're looking at the completeness and the accuracy of the data, make sure it's data that we can work with, that there aren't any key pieces that are missing, and that we're essentially ironing out any wrinkles to then enable us to be able to analyze the data itself to identify unclaimed property. A big part of this is data normalization. A lot of times, especially if you have multiple systems in play, the data pulls and the queries that you're able to run aren't common fields necessarily, and so making sure that the actual formatting itself is workable, and if you need to identify unique account identifiers, that it's done so, and essentially it's just getting it to a point where we're able to then utilize the data and run with it at our end to identify unclaimed property. This essentially is, a thorough review. It's looking at transactional items of data. It isn't, it's looking at line items themselves, because essentially the point of the audit is looking for accuracy and completeness. And, depending on how long a data set is in, the hands or is taking to review, potential data update may be necessary. For example, towards the beginning of an unclaimed property examination, one common data request that's issued is for an unclaimed property system data system, if you have one, which if you do have one, it can be a field where you house unclaimed property as it's identified before it ends up getting remitted. That tends to be towards the beginning of an examination. So as you work through the remaining data requests for specific property types over the course or the life of an examination, a data refresh may be necessary of the UP system, or just as an example, to determine whether anything has since been added to it that wasn't yet in the system when the original data pull was done. As far as, could you just go back one second? Thanks. So a lot of what we'll be looking at when we're doing the data analysis is escheatability processing. This is looking at specific dormancy periods for specific property types, dependent on the state as well. As I mentioned, in the multi-state examinations, one property type may be dormant after 3 years for one state, but it may be dormant after 5 years for another state. And so that is one nuance that's being taken into consideration as well as we're working through the data. So as we work through the data sets and we work to identify any past due property, what will end up happening is we'll put together a population of what's been identified as potentially past due properties. We'll put this into a report and we'll send it back over to you all, where you'll look through it and you'll identify whether you're in agreement or not with respect to those properties. If we need supplemental data and information, we'll get it at that point in time. For example, a check that may appear as unclaimed in the population from the data that we originally receive, that we send back to you, may have subsequently ended up being claimed by an owner. It may have subsequently ended up, being escheated or reported. The data as we receive it is as good as the date that we receive it. Obviously, in practice, however much time that passes between when we receive those data sets And when we identify past due property, something could happen with respect to the property where it ends up getting claimed. And so when we give you guys back that potentially past due report, that's where you'll work through and reconcile whether those properties are still past due, if they are actually past due, or if they've since been paid. Following that, due diligence would then take place for properties where it hasn't yet. This follows the statutory requirements and the timing pieces that we talked a little bit about before, and the intent there is obviously to reunite the property with the owners at that time. So essentially, after due diligence, whatever is still left on, or left within a population that you agree is past due would then be reported. It's in conformance with normal state requirements and NAPA formatting, and it continues statutory obligations after the audit concludes. And so we will provide instructions at that time with how to go ahead with the reporting if it ends up being a report that's done through the audit itself, outside of your annual report that you're filing in either the fall or the spring, depending on your industry. So following all of that is the conclusion of the exam. Final reports will be generated that identify basically a summary of what I just described. It'll outline findings of the examination itself, methodologies that were used to identify and determine amounts of unclaimed property, any documents or disputed issues, if any that come up, record deficiencies. It's essentially just a final report memorializing, the course of the audit itself. And so essentially, if you find yourself, wondering, okay, if I end up receiving one of these audit, authorizations or audit notifications, what's the best way to prepare myself? Best practices are to just understand what is unclaimed property, as you all are doing today and why you're all here today. Make sure that you establish policies and procedures that address those and implement, whatever those requirements are, and that you're checking for updates on those rules themselves to make sure that you're current and that you're essentially following the requirements of the Unclaimed Property Act. Does anybody have any questions pertaining to the audit process and if you end up receiving an audit notification? All right, thank you for your time today.
Thank you, Andrew. That was great timing. And if anybody has any question about anything so far, we can take 3 or 4 minutes and touch on those. If not, we will reset and get ready for our panel. So I'll give you a couple minutes, and if anybody has any questions, I'm going to read one question that came in online just a few minutes ago. Let me find the right one. Because it was a great question that I don't believe we've covered so far, or if we have, we might have skimmed right over it and talked so fast that nobody picked up on it. It's basically, and I'll summarize it because I'm not coming to the exact question, but say you are sitting in on this seminar and you realize, oh, I hadn't submitted any due diligence. I hadn't sent any notices out, and we require 90 days before you submit your report. Okay, we want you to still do that 90-day period. If you haven't gotten your letters in the mail, go ahead and get them in as soon as you can, and then wait the 90 days to report. While in that same vein, as soon as you send those letters out, or right before you send those letters out, send a written request into our compliance division asking for an extension of the reporting deadline. And we can extend out as much as 120 days without managerial approval. So get on it as quickly as you can. And you can send a written response, and it just basically has to say, hey, I hadn't sent my due diligence letters out yet. I need an extension. give us your federal tax ID number, the name of your business, that brief description, and you can email it to us. Just send it to holders@auditor.ar.gov. Anybody else have any questions? All right, let's take a quick break. A little bit of an extended break. We're gonna come back at 2:10 for our panel. All right, thanks, guys. Hello. Testing 1, 2, 3, 4. All of them are working. Cool. Well, we've got 4 minutes left until we break into our question and answer sessions. Everybody submitted questions when you registered. We're going to try to touch on some of those questions. Maybe we get through all of them. We probably won't, but we're gonna do our best to get through as many as we can. So with that in mind, does anybody have a super awesome dad joke to tell? Anybody?
Hello. Yeah. What kind of house weighs the least? That's right, a lighthouse. What is the scariest type of plant? Halloween's coming. Nobody? It's bamboo.
Anybody else dad jokes? Mom jokes? Aunt jokes? All right. Yeah, I don't have any either. I am very dry. But I will ask you, what is, by raising hands, do you like sweet tea or regular tea? Sweet tea? All right. Well, how about regular tea? Okay, there are some bitter folks in the world. I'm so sorry. So what have you taken away? I'm always interested in asking the question, what's the biggest thing that you've taken away from this? Is there one thing that stood out that you haven't ever heard before, or you have, but you heard it in a different light? For sure. Yeah, that is helpful. Yeah, if you've been a state entity for years and years and years, and you open a branch up in another state, you open yourself up to different legislators or different regulators. Now that being said, with unclaimed property, you still could have an obligation to report based on the state of last known mailing address to all 50 states. It's not likely that you end up reporting to all 50, but maybe 5 or 6. All right, I guess anything else that's jumped out? I think we've got about 20 seconds. Before we get all of the online folks, we can come on up, guys. All right, just so y'all can see, I've got 1, 2, 3, 4 pages of items that or questions that were asked at registration. So we're likely not going to get through all of them, but we're going to make an attempt to get through as much as we can. So I've got my handy dandy pen so I can mark off so I don't ask things twice. All right, and we are hot, right? Cool. All right, we are ready for our panel of unclaimed property experts answering questions that you asked at when you registered. So we're going to do our best to get through as many of these questions as we can. I can't make any promise that every question is going to get answered, but we're going to try. Some of these questions were already answered by the content that we had, but if we have time, we're going to come back through those as well. So we're going to hit on some hot topics that are pulled out of these questions. Again, we've got Andrew Mudgett, Shawn Hibbard, Robert Scott, and Curtis Irving, and myself, Josh Wood, who Curtis and I have worked in the office for more than 18 years. Rob worked in our office for 20 plus years, but now he shipped off and is working for a third-party audit firm. And Andrew and Shawn work for our third-party audit firms as well, our vendors, who conduct audits on our behalf. So I'm going to kick off with a question to Andrew, if you're ready. May the odds be ever in your favor. All right. Where funds should be escheated when a beneficiary leaves in a different state from decedent? I guess it's lives, probably.
So generally speaking, when there's a beneficiary that lives in a different state from the decedent, you're going to use the beneficiary address for reporting those funds. So you'd use that beneficiary state.
Awesome. All right, Rob. If a restaurant is situated at Arkansas State and employee is working in Arkansas, but employee's home address is in Texas or another state, how do we have to report unclaimed property returned to Missouri or Arkansas?
So this one's pretty much going to be the same. It's wherever the employee's last known address is will be the state of jurisdiction to report that property. Only would it be reported to another state if you had no last known address for the employee. Then it would go to the business's state of incorporation.
All right, Shawn, because I got a question from an online participant, I'm going to add on to the question that I've got here for you. Sorry I didn't prepare you for it.
We'll see how it goes.
Okay. Do payroll checks that are uncashed go to unclaimed property?
So the quick answer is yes. Is the add-on ready? Or should I add on?
I'll add on.
Okay,
All right.
go for it.
So if the payroll checks are managed by a third-party provider and the TPA only provides certain information at the end of the year and then writes off the record, what is the company's obligation or requirement?
So I think what would make sense if you're working with a third party is that you understand your contract with a third party, understand who has the obligation to report. Ultimately, just in the example you gave, just writing off a particular item sounds like a bad idea to me. You would want to, again, assuming that you, the holder, you have the obligation according to the contract, then you would want to get that information back. Once that dormancy period has elapsed, then you can go through the due diligence process and ensure that that item is reported and remitted to the state if you're not able to reunite it with the owner.
Awesome. Good answers. And I'm getting questions in on my phone for the panel as well that we'll get to if we have time after these ones that we've highlighted. All right, back to, well, let's go to Curtis. Curtis. Can a property for a deceased person be given to their executor, estate, or a relative? Can you answer this from a claims perspective?
Absolutely. There are some steps that have to be taken for that deceased owner to, first, the deceased owner has to have some sort of probate. So when somebody dies, if they didn't die intestate, which means they died without a will, they would have to have a probated will that a judge or an attorney sets up for them, or someone has, and that's filed with the courthouse, and there's proceedings to go from opening to close. And so in that case, if the state is still open, we will pay to the executor or executrix that is listed for that estate. So it could be a relative. It could be someone who's appointed to be over that estate. And we would, in our state, we would pay it. If it's open, we'll pay the estate in care of the executor or executrix. An option to that, if they didn't die with probate, they would follow the affidavit of heirship law for Arkansas, which gives spouses 1/3 and children 2/3. And so we would have to follow that table of descent that goes all the way down. So it depends on where they are at on that table of descent. They could be all the way down the line, because we have people that's grandchildren. So the affidavit heirship is going to be pretty long. And if it's depending on the amount of money, you may not get much or you may get a lot. So
just for the record, we have paid grandnephews. That's super hard, but we get there. All right, Andrew. When someone passes away with wages and no probate has been opened with no next of kin. So I'm guessing that's what do we do? How do we report items that is wages that has probate with no next of kin?
Yeah, so this one isn't too dissimilar from what Curtis was just describing. Ultimately, in this instance, it happens to be the case where it sounds like a probate estate hasn't yet been opened. So if it's a case where there is no will, you're going to follow. Ultimately, it's an intersect right now of the laws of Arkansas's intestacy versus also unclaimed property reporting. So you ultimately would still report the funds, and then it's going to be decided upon, or somebody's going to decide on who is owed those funds if there's no next of kin by following the hierarchy of the descendants. And if it's not next of kin, maybe it'll work its way down to a grandnephew. But ultimately, it's going to be dictated by Arkansas's intestacy laws.
Thank you. Let's go with Rob. Is filing based on where the unclaimed property originated from or where the individual lives?
Again, this kind of goes back to the previous question. So the filing would be with the state of last known address of the owner of the property, regardless of where it originated, the payment originated from. In almost all cases, with exception of money orders or certain types of checks, but other than that, it would be to the state of last known address of the owner.
All right, Shawn, this question's for you. Explain what a process or cycle looks like for unclaimed property.
Okay, so I interpreted this as the reporting cycle. So for non-life insurance companies that have a report due on or prior to November 1, on 6/30 of that year, you would review your books and records to determine if there are any items that became eligible for reporting that year. Perform your due diligence on those items shortly after that 6/30 date. After 90 days, you would begin to prepare your report and make sure that you turn that in prior to the November 1 date.
Thank you. Andrew, this one's for you. Are most of your laws specific to Arkansas, or are they universal to most states? And do you submit unclaimed property to the state we're located in or the state of the last known address of the property owner?
Yep. So we talked about this a little bit in the presentation, but Arkansas's laws are going to be specific to Arkansas. Each state is going to have their own set of unclaimed property laws. They may be, depending on the state, similar in how Arkansas's are set up, depending on which model act was used to draft that state's laws, or they may be a little bit different, a little bit nuanced with the specific property types, again, depending upon which model act that state used. So Arkansas's are specific to Arkansas. And then the question about, do you submit unclaimed property to the state we are located in or the state of last known address? So as Rob just mentioned, generally speaking, most property is going to follow the priority rules established in Texas versus New Jersey, which is the first priority being owner's address, second being if there is no address, then you would use the state of domicile. And the nuance to those is for very specific property types, such as money orders, is where you would, potentially get into a place of purchase situation. But the vast majority of the time, what you're going to be running into is owner's address followed by domicile of your company if there is no owner address.
So in other words, the courts direct that. Which, thank you for that great explanation. Shawn, this one's for you. How to report unclaimed outstanding payroll checks and submit payment to the state of Arkansas.
So I think we've touched on this a bit, but for payroll checks after that 1-year dormancy period has passed, take that item, perform due diligence if you need to, and then ultimately you'll be preparing your report. You'll submit your report through the state website. There are a couple of options. You can enter a manual report. It can take a little bit longer depending on the number of items you have, or you can submit an electronic report. The report that goes in, it's in a format referred to as a NAPA format. So many holders use a third-party software to generate that report, and then they're able to go and upload that directly through the state website. Once that report goes through, then you need to make sure obviously the remittance and the payment goes through, and I think that's was covered earlier today. The preference is a single payment paid by the methods that are listed through the state website.
Okay, Andrew, this one's for you. I'm gonna ask 2 questions back to back of you. Does the RPO date matter if the date of last contact is over dormancy period?
So yes and no, and it depends on the property type itself. In the case of financial institutions, a return post office or a mailing going out that is then returned as undeliverable, that in and of itself would reset the dormancy period. So I guess the absence of an RPO is an indication of owner interest, whereas, like I said, that's specific to financial organizations. If you're not a financial organization, it wouldn't be applicable, and so RPO wouldn't have an impact on the date of last contact there for dormancy period.
Thank you. And I'll move on down the list, and this next question has 4 questions within the question. So I'll read it out, and then Andrew has it so he can reread it before he answers the question. I work at a financial institution, and my questions are, number 1, if someone has a dormant account, but they also have active accounts, can that be a reason to remove the dormancy? What if it is a single person that has a dormant account but has an active joint account? Can that active joint account nullify the dormancy? And number 2, if we have it documented that their address is no good, do we still need to send a due diligence letter? Number 3, if a person is deceased and they have no payable on death or joint owner on the account, do we still need to send a due diligence letter to that person? And number 4, for money orders and cashier's checks, if it was purchased by a person on a joint account, can the other joint account owner reply to the due diligence letter? I'll turn it all over to you.
Okay, so if someone has a dormant account but also has active accounts, can that be reason to remove dormancy? Yeah, so if you have somebody that has more than one account, activity on one of the accounts would be sufficient for the account where it appears that there isn't currently activity going on. So that would be able to remove dormancy there. If it's a single person that has a dormant account, but an active joint account, okay, so but the joint account, activity nullify dormancy. Yeah, so same thing there. That's just an example of what the second account might look like. If we have, okay, so if your records indicate that the address is no good, no, you do not need to send a due diligence letter. If a person is deceased, and they have no payable on death, do you still need to send due diligence? So best practice is, yes, you'd still send a due diligence letter, because ultimately, if the person's deceased, kind of what we touched on before, at an intersect with, probate here, it's an estate that's going to be opened up. The funds will be payable to that decedent's estate, which would then follow either, as the will dictates for how it should be paid out, or, the laws of intestacy if there is no will, but ultimately it's still payable to that estate. And so you'd still send a due diligence letter out to that. And then for money orders, cashier's checks, if it was purchased by a person on a joint account, can the other joint owner reply to the due diligence letter? Yes. So on a joint account, both owners of the account, they own the funds, they own the contents of the account. They're both legal owners. So the second person on the account could reply to a due diligence letter.
All right, thank you. And good questions. Appreciate it. Let's go with Shawn. There any common mistakes made by leaders who manage their company's unclaimed property?
I think one of the most common mistakes, or one of the biggest mistakes that could be made, is not having a good set of policies and procedures, documenting those policies and procedures, and then ultimately testing those and making sure that they're being followed. Earlier, I was talking about the gap reporter example, where an individual had the responsibility to report, and then maybe they moved on from the company. Having policies and procedures in place, having sign-offs in place, that would help prevent a scenario like that. So even if that person wasn't there to complete the report, it would get kicked up to a manager, for example. The manager would say, oh geez, this report was never filled out, and then you have an opportunity to get out in front of that and get the report submitted by using other resources. So I think policies and procedures, not having those, would probably be one of the biggest mistakes.
Agreed. I'm going to go to one question that I got here, and it says, will the presentation be available to watch later? Yes. There will be a recording that will be posted on our website, so you'll be able to watch it later, and the slides will be available on our website as well. It'll be under the reporting features drop down on our website, and just click on the 2025 seminar, and you'll be able to have access to it until next year when we redo it. Assuming we redo it next year. We may be too busy. Who knows? No, we'll likely do it. All right, Andrew, this one's for you. All right. Pursuant to the Unclaimed Property Act, presumptions of abandonment states that an indication of an owner's interest in property includes correspondence from the financial organization to the owner of the property by mail which correspondence has not been returned, unclaimed, or undelivered to the financial organization by the Postal Service. Does this include paper statements mailed to the customer?
Yep. So generally, if we're talking about like a monthly bank paper statement there, we would consider that as written correspondence. Where it starts to shift away from that a little bit is if it's something like a promotional material, something that's marketing or trying to get somebody to, sign up for a new credit card, like something along those lines wouldn't constitute the correspondence as much, but a monthly bank statement going out, something to that effect would be included within the under that definition.
I'll just add a follow-up. That shouldn't be the only thing that you look at when you're looking at an interest in if the owner has or if you're looking to show that an owner has interest in the property. And I'll leave that with a question. Are you fully reliant that every letter that you send through the Postal Service is going to get to the rightful owner or the rightful recipient? And that if it doesn't, that you're going to get it back? I see a lot of no's. So that's where I leave that with the question. Yes, it is allowed in the statute, but is it the right thing to do? Okay, and I'll take this next one because I don't want anybody else to take a bullet for what we're doing that nobody else in the nation is doing. So here we go. Please clarify the pre-clearance requirement. If we only have shares to deliver for IRA accounts, do we need to provide the NAPA reports before delivering the shares? Okay, so I'm going to go through the process and just talk through it. It's a 4-step process to report shares to our office. Okay, the first step is to send us a notice. Just send us that you're interested in reporting shares to our office. And we'll need a list of all of the shares that you're looking to report. Namely, the name of the share, the QSIP number, the number of shares that you believe you're going to probably report. You're not at the point of reporting, but we're talking about, are we going to accept that position as reported to our office? So that's first step. You send that to us, and then we'll review that. Generally, it takes maybe an hour, depending on who's sitting at a computer at that moment. And we'll confirm if it has value or not. That's where we'll say we'll decline to receive certain positions of shares because it may be worthless or fall within our scoping of what we consider to be in our reporting booklet to be as a worthless share, which is any share that is valued less than a penny per share is considered worthless. If it's delisted, if it's frozen, things like that, we wouldn't agree to allow it to be transferred into our custody. We want to have full control of every position that we have. We want to be able to issue an order to sell or an issue to transfer it to an owner. If we can't do that, it doesn't help the mission of returning unclaimed property to its rightful owner. So the next step is we say, okay, yes, we'll accept all of these shares. We're not going to decline any of these shares. You can go ahead and submit your report of unclaimed property now. And now you go through the reporting process. We require a report to be received before we receive any shares because we need a record before we can have a payment. So once you submit your report of unclaimed property, you're not transferring any shares yet. You need to submit your report because we may reject your report because it doesn't have sufficient owner information. So give it some time. Generally, it takes maybe 24 hours for us to issue an opinion on whether it's rejected or accepted. So we get a report of unclaimed property. We don't reject the report. now follow up and send an additional an email over to holders if we haven't already followed up with it. When I say holders, it's holders@auditor.ar.gov. I always call our email address holders. And then we'll continue our review for approval to remit shares or transfer shares into our custody. So once you get the go-ahead from our office, that's where we hand it off to our Kelmar custody team and say, okay, if there are any mutual fund accounts that need to be created, or if they're DTC or DRS eligible, they can just be pushed in at that moment. But that's where that handoff takes place. We hand it over to our Kelmar custody team to help you transfer the shares into our custody. The alternative or the exception to this to that rule or that requirement is if the shares are held within an IRA account. Okay. IRA accounts, if they have tax withholding requirements, that's the exception, because they can't be reported before they're remitted, because you may end up having to sell some of the shares to pay some of the taxes. So you're not going to know that on the front end. So because of that, we provide an exception as long as you tell us up front that these shares are held in an IRA account. When you send that initial notice request for our approval, you'll need to tell us that it's held in an IRA account. And then we'll tell you, okay, now you can work with the Kelmar team to bring the shares in, and then your report is due no later than 14 days from the date the shares were transferred. All right. And I'm sure there will be follow-up questions later. Remember that holders@auditor.ar.gov. Send us any questions, and I'm sure Melanie will be happy to respond to you. And this last question that we have teed up to answer is going to go to Andrew. All right. How do you handle specific cases where the money goes to a deceased party and their heirs are deceased? No other information is given.
Yeah, so this one, this one's very similar to some of the other questions that we talked about addressing, probate and whatnot. This is at the intersect there, and ultimately the funds will still be reportable. You'd report them in the decedent's name or the estate of them if you have estate information. And ultimately, it would then be up to whether it's a will or the laws of intestacy to determine who is the rightful person to make a claim on those funds. But ultimately, the funds would still end up being reported.
Okay, we're going to move on to some questions from some online participants. This one is pretty similar to that question, so I'll go ahead and give it to you as well, or anyone else that wants to jump in and answer it. Good afternoon. I'm attending the webinar online, and I had a question. If we have a member who we have found an obituary on, but had not been notified prior to them passing, and they've had a debit transaction, so their account hasn't gone into dormancy or qualified for escheatment, what timeline or process would we need to follow as far as escheating the account out? Actually, I'm going to jump on this one. So my question back to the person is, what type of debit transaction was it? Is it a transaction that they used their debit card to purchase a certain thing, and how did they use their debit card if they're deceased? So there are several questions there, but it comes back to owner-initiated transaction. When in session 1, presumption of abandonment, you need owner-directed activity in the account. So if there was owner-directed activity in the account, and the owner has not shown interest in the account, assuming it's an account balance, then it could be turned over based on the last interest in the property. That being said, if it's a different type of property and you're looking at due diligence, that's a different process altogether. So if you have additional information to provide, please send it to holders@auditor.ar.gov, because I think there's, as you hear me talking, many different ways to answer that one question. And we need more information to really answer your specific question. Okay. Oh, this is a good one. And this is not something that our state has really gotten into, because we don't have a lot of casinos. But I'll throw it out because there are a number of states that do have a number of casinos that do report property, and this one isn't even casino related, it's online betting related. So anybody abreast on online betting very much? Yeah. I'll attempt. What would happen to the unclaimed rewards for online gaming? Would it be treated as unclaimed cash? If it's a cash derivative, then yes. If you can turn it in for cash, or you can purchase things with those rewards, then it could be considered cash and it could be reportable. Okay, I'll leave it at that. All right. Let's dive back in here. Actually, we've got 7 minutes, so I'm going to open it up to the room, or anybody that wants to send in a text message or a question as well for the next 7 minutes, so that we end on time and I don't go over, because you guys' time is important, and I know you've got important things to do when we leave, and I don't want to waste your time. Does anybody have any specific questions for the panel or for the group that haven't been answered so far, or that you need clarification on?
Yes. What happens to the funds after it's sent to the state and no one claims it? Do they just stay in an account earning interest for however long?
Okay. The question was, what happens to the money that's turned over to the state? Does it just stay in the account, or does it earn interest? Basically, the accounting mechanism. How do we account for the money that comes in? The easy answer is when it's reported, when a record is reported as unclaimed property, it's held in perpetuity. It's held forever, and a person, until they claim it, is going to be able to be made whole, is going to be able to claim that money. But I think you're asking about the larger perspective of, okay, what happens to the big pool of money? And does the state earn interest on it? Of course, yeah. That's how we get paid. That's how we have employees in the office. Our office is generally self-sustainable to the extent that that Congress allows us to be. Now, some of the money is turned over to different funds for the use of the state in general. That being said, we want good roads. We want the state to be able to use the money if it's not being claimed. That being said, we do hold a certain liability. We create a liability. We run a liability report every year. So we're holding a percentage of that money on hand, but we can always grab back more money if we need to. Or I say always, I should say that lightly. We'll have to submit a claim to a certain division to bring money back in, but we'll be able to do that. I don't want to go too far into that. Any other questions?
Yeah, similar to the online gaming, the casinos, when you put money in a slot machine and you get it out, it prints a voucher nowadays. So someone had to initiate the voucher, so it is their money. However, if it's not cashed within a certain number of days, it expires. What should the casinos, what's the rule on that?
Here, let me let you ask that for people online. Oh, it's not gonna get there. I don't think I can rephrase that.
So we have casinos in Arkansas and slot machines now. People put cash into them. When the customer initiates the collect money, it's their money. They get a voucher. They don't get coins and dollar bills. If they don't exchange that at the cashier, over a time period, it'll expire. That is not casino money unless there's a law, some kind of loophole that says it reverts back to the casino. It was initiated by a customer, an Arkansan or who knows which is the real problem. What should be happening from an unclaimed property perspective with those uncollected vouchers? Because in Arkansas it might be immature, but in Nevada it's in the hundreds of millions.
Generally, it depends on what information is collected. Usually when you go up to, say, a slot machine or something, you put in the card that the casino gave you. They're tracking that card for rewards. They're tracking that card to keep up with how many funds, how much you've spent, and they should be keeping up with all of that information with the tickets as well, or the redemption tickets. So I would presume that they should be able to return that to a person, and that if it is trackable by way of that mechanism, then it could be considered to be abandoned property and reported as unclaimed property.
It'll be interesting after the first, whatever the period is for that. It'll be interesting if they start reporting, or if they have to wait till you reach out to them.
Yeah, comment was it'll be interesting if casinos or others will start reporting, or if the state or states will have to reach out to them to initiate that. I will point out that NAPA, the National Association of Unclaimed Property Administrators, does have a webinar that is available on this topic, available on their website to view. Go to unclaimed.org. That, in big part, that webinar was driven by the Nevada State Treasury Department. Any other questions? Make sure I hadn't got any on my phone. And I do have one. Let's see here. Okay, it was just a follow-up question about the debit transaction. It is an ACH transaction. Feel free to reach out to holders at auditor.ar.gov and give specific information on the transaction, and we'll be happy to look at the specific information. and answer it to the best of our ability. Are there any other questions? All right, guys. Well, thanks for your time. We appreciated having all of you here in person and everybody online. We get as much from you as I hope you get from us. I hope I hadn't put anybody to sleep, and definitely not Andrew here. I'm pretty sure he was snoring right here next to me. Thank you so much, and I hope you guys have a safe drive home, or I hope you guys at home get another cup of coffee and forgive me for putting you to sleep. Thanks, y'all.